Good evening, everyone. Good evening, everyone. Good evening, Ishika. Good evening, Manan. Others, good evening, good evening.
Good evening, sir.
Good evening, Manan. Some technical issue was there. That is the reason. So, look, good evening, buddy. If you have not watched yesterday's lecture, it is uploaded on YouTube and I have shared the link in the group. So, you can watch it. So, yesterday we have covered IAS 16, IAS 38, IAS 40, then IAS 20, IAS 23, IFRS 5, IAS 36, IAS 2 and IAS 41. It's uploaded. It's uploaded. I have pinned the message also. Not uploaded. It's uploaded. I hope you are there in the group, the revision group. Not okay. Please check now, everyone. I will share it again. Let me share the link here also. Chat box. I'll share the link in the chat box. Please check now, everyone. Yes, it's uploaded. Chalo. Good evening, everyone. Good evening. Chalo. Can we start? So today we will start the discussion regarding what? As I mentioned to you, I have divided this syllabus in 5 parts. So yesterday we have completed the part 1, and in part 3 we have completed IAS 2 and IAS 41. So today we will do part 2 and some standards in part 3. So now today the agenda will be to cover part 2, and it's very important for your section B. As mentioned, out of 3 questions, 2 questions will be from this. If it's your very good day, we say 2 questions. If not, 1 question can come from this. And in this also, EPS, financial instrument, revenue and lease. Deferred tax, it will not be tested. I have not seen a question in section B regarding deferred tax. These 4 standards are very important. And either you can have a question from part 1. We have discussed yesterday what is the weightage also, etc. XYZ. Now, chalo, let us start with today's class. So today we will discuss IFRS 16, IFRS 15, financial instrument, EPS, then deferred tax, your income tax, and then IAS 8, IFRS 13, and IAS 21. So chalo, let us start with the discussion of IFRS 16, a very important topic for FR. So now starting with the concept of lease. Now what does a lease means? Lease means giving a property on rent in basic sense. So normally if I have given a property to you on rent, what will you record? You will record every year 10,000, 10,000, 10,000, 10,000 as an income. But IFRS 16 says what? IFRS 16 says that what should you do? You should discount the cash flow and you should record right to use asset and lease liability. The ultimate expense when you pay the rent of 10,000, the ultimate expense will be how much? 50,000. And when you record right to use as asset and lease liability, the expense also will be 50,000 only. But IS and IFRS works on the concept of discounting as we have seen. So now what is a lease? Lease is a contract that conveys the right to control the use of an identified asset for a specified period of time in exchange for consideration. So whenever an asset is given for a specified period of time, and there should be exchange For consideration, either the consideration can be in the form of cash or in the form of kind, and the asset should be identified. MCQ question, important. Identify. Now here the lessor can have protective right. So the asset should be identified. The asset should be mentioned in the contract. And right to control the use means what? The person should have the right to take all the benefits and direct the use of the asset. And it should be a contract. Contract means legally enforceable right between two parties. I hope the definition is clear to everyone, please. Now, the person who gives the identified asset is known as what? Lessor. The person who takes the asset is known as lessee. So lessor is the owner, lessee is the third party who takes the asset on the lease. Now, when starting with the date of lease, there are two important dates here. The first date is what? Inception date. The second date is what? Commencement date. Inception date means what? The date when the contract is done or when the agreement is done between the lessor and lessee. Commencement date means what? The date when the building or when the asset is handed over to the lessee. The date on which the asset has been handed over to the lessee. On this date, on the commencement date, we will start doing the accounting. On inception date, it will help us to identify whether the contract is a lease or not. It will help us to identify whether the contract is lease or not on inception date. On commencement date, what will happen? The asset will be given to lessee, and from that date we will start the accounting. So I hope this is also clear to everyone. Now starting with the accounting in the books of lessee, you have the accounting for lessor and lessee, but in FR only the accounting for lessee is tested, and sale and lease back and recognition exemption. So now starting with the accounting in the books of lessee, initial measurement. Initially what we will record, initially, the lessee will record what? Initially the lessee will record a lease liability and right to use asset. The lessee will record what? Debit right to use asset and credit lease liability. This lease liability will be treated as a non-current liability, and current liability we'll see, and right to use asset will generally be treated as an asset under the heading non-current asset, and it will be depreciated over the lease term or the useful life. We will see that. Now when you calculate the lease liability, how do we calculate lease liability? Lease liability is the initially measured at what? Present value of the future lease payment. Whatever is the rental payment or the lease payment which you're doing, you will discount it and record it as a lease liability. So what are the five elements of lease payment? First one is the fixed payment. If you receive any incentives, you will reduce it from the fixed payment. Then you have a variable payment. Then you have exercise price. If I am the lessor, you are the lessee, I have given the asset to you, and you have the option to purchase this asset at the end of the lease term. If you say that, sir, we will purchase the asset, then include the purchase price in the calculation of lease liability. If it is reasonably certain, the lessee will see, if it is reasonably certain that we will exercise it, we will purchase it, then we will include in that. Then penalties expected to be paid for early termination. If any penalty you have to pay if you're terminating the contract before the period that is mentioned in the contract, you have to consider that also. And then fifth one is what? Guaranteed residual value. Guaranteed residual value also we will include. I hope everyone knows what is guaranteed residual value and unguaranteed residual value. Guaranteed residual value will be included in the lease payment, but the unguaranteed residual value will not be included in the lease liability calculation. And there could be lease payment as well as non-lease payment. If I say today you have taken an asset on lease, if you have taken an asset on lease, then you are paying 10,000. Out of this 10,000, 2,000 is paid for maintenance service. This will become what? A non-lease component. This is a non-lease component. Then this 2,000, what should we do? We should separate it and record it. We should not include in the lease liability calculation. Either the lessee can include or either they can record it separately. This will not be tested in your FR. Only you should know in theory. For theory, for MCQ purpose, it is important. Lease payment allocated to non-lease component of a contract unless the lessee elects to not to separate lease or non-lease component. If the lessee is saying that we will record it separately, no issue. If the lessee is saying that we will record together, they can record. It's an option which is available with the lessee. Now, which is the discount rate we will use? The discount rate which we will use is what? The implicit interest rate. Implicit interest rate. If the implicit interest rate is not available, we will use the incremental borrowing rate. But for your FR exam, every time examiners have mentioned that the interest rate will be given in the question, and that interest rate will be what? The implicit interest rate. It will be given in the question. So lease payment we have discussed. What is discount rate also we have discussed. Now coming to lease term. Now what does lease term means? Lease term will include what? Non-cancelable period plus period covered by an option to extend the lease if reasonably certain to exercise. So see here now, I have example here. Non-cancelable period is what, sir? 5 years. Option to extend is what? 3 years. Option to terminate after 3 years. But they mention what? The lessee is reasonably certain to extend the lease. If the lessee is saying that we will extend the lease, then the lease term will become what? 5 years plus 3 years. In total, the lease term will be 8 years. On the other way, if the non-cancelable period is 5 years, option to extend is 3 years, and option to terminate after 3 years. So after 3 years, we can terminate. In that case, the lease term will be what? If the lessee is reasonably certain to terminate the lease, then we say the lease term will be what? 3 years. It will be 3 years. So lease term also will be mentioned in the question. So this lease term will help us for the calculation of depreciation. It will be helpful for the calculation of depreciation. So with this, I hope everyone have understood what will be included in lease liability, what will be the discount rate, and the lease term. Then coming to right to use asset. How will you calculate the right to use asset? The right to use asset will include what? The initial amount of lease liability, whatever you have calculated by considering the present value concept that you will take. Then payment made before the lease commenced. Before the commencement of the lease, if you are paying any payment before that, after the inception date and before the commencement date, that also will be included in the right to use asset value. Initial direct cost, this is the favorite part of the examiner. A lot of times the examiner will give this, you have to include in the right to use asset value. And any dismantling cost, like we have seen yesterday in IAS 16, dismantling cost. So what we record, debit, credit, we record it as an asset and we record it as a provision. This provision will be recorded under non-current liability, and you will unwind it, and interest expense will be recorded in financing category. So this is the calculation for right to use asset. So what is the journal entry we pass on the day one? Before commencement of the lease, before the commencement of lease, if any payment is paid, we record what? Debit, prepaid lease payment, credit bank. And on the commencement date, what we do? We record right to use asset. Right to use asset will include 4 values: direct cost, payment made before commencement, the dismantling cost, and the present value of the lease liability. Then lease liability will include 5 components. We have discussed it. And debit bank, if any incentive is received; credit bank, if any incentive is paid, or you will credit the lease, prepaid lease payment. And then what will you do? Credit provision for dismantling cost, and this provision cost will be included in the right to use asset. So with this, we have completed the initial recognition. Initial, it's very simple. Just you will discount the value, you will record right to use asset and lease liability. Then coming to the subsequent measurement. Subsequent measurement for lease liability. What do we do for subsequent measurement in case of lease liability? After initial recognition, the lease is increased by an interest on the outstanding liability. So normally we prepare the amortization table and we add interest. Then we reduce the lease payment. We get the closing balance. Same as per your IFRS 9 amortization table. So we consider what? We take opening lease liability plus finance cost during the year, less lease payment, we get the closing lease liability. So during the year, we charge finance cost debit, credit lease liability. This where will you record? Very important. We will record in financing category or the new format of the P&L in financing category. And once you pay the payment, lease payment, can I say the cash is going out and the lease liability will be reduced. So this is the table which we prepare now. Lease amortization schedule. This is what payment in arrears. If the payment is made in arrears, then this is the table. Opening balance you write down. We charge interest. This will be taken to financing category. Then any lease payment you reduce. Then you get what? Closing balance. This closing balance you will consider this, and this will be split into current and non-current. Same we have seen yesterday in IAS 20. We recorded current and non-current. Here also the total lease liability will be classified into current liability and non-current liability. So now what will be the current and non-current liability in case of payment in arrears? See here now. In case of payment in arrears, non-current liability will be what? Non-current liability will be the next year balance. Whatever is the next year lease liability, that will be non-current liability. Then the current liability will be what? The carrying amount of the lease liability minus the non-current liability portion. That will be a current liability part. So first, in case of arrear, what should we do? If I say my closing balance here is 10,000 and next year it is 8,000. So what will I do? I will consider this 8,000 as my non-current liability, and the difference of this 10,000 minus 8,000 will be what? 2,000 will be my current liability part, will be my current liability part. In case of arrears, I hope everyone have understood the case of arrears. In case of advance, what will happen? In case of, if the payment is done in advance, in that case in that case, see here, the first payment is done today only. In that case, what do we do? In that case, we will only discount these three values. We will only discount these three values. We will discount these three values. And what we will do, once we discount the value, let us take, we are getting the value as 26,000. It's an assumption, 26,000. Now, this is the present value of the lease liability considering only three payments. Then what will I do? I will add this 10,000. So this is my total lease liability before any payment. Before any payment, my total lease liability is how much? 36,000. Today I calculated the value 36,000. After this 1 hour or 2 hours, I do the lease payment. I pay the payment. So ultimately, we will get what? Ultimately, it will come to 26,000 only. But when you do right to use asset calculation, will you take 36,000 or 26,000? We will take 36,000 for right to use asset calculation. Understand that. It's very important. So, yes, you know, opening balance, my opening balance was how much? The opening balance is how much? 36,000. Then on the first day only we are doing the payment. So 36,000 minus 10,000, I will get what? I will get my revised opening balance. On this revised opening balance, we will charge the finance cost. So A minus B, you get your revised opening balance. On this we charge interest. This interest is taken to financing category, and then you get your closing value. Now this closing liability also should be split into current and non-current. In that case, how we will do? See here now. In this case, how we will do? In case of advance, the current liability will be what? The payment done at the start of the next year. That means if my year end is 2000 x1, on 1st January 2000 x2, what is the payment? Next year I will be doing the payment of 10,000. So my closing balance is, let's take 35,000. Out of this 35,000, 10,000 is what? Current liability. The non-current liability will be what? Total liability minus current will be 25,000. So in case of advance, the current liability is very simple. Current liability will be the payment which you do in the next year. The payment will be what? Lease payment. So with this, we have discussed how do we split the lease liability. So now how will you present in your balance sheet? In the balance sheet, what do we record? Non-current liability and current liability. Then in P&L, what we record? Finance cost. Under which category? Financing category. Under which category? Financing category. Now the examiner has mentioned that you have to split the liability between current and non-current. If you prepare your single entity question, if a single entity question comes, please do this. Marks will be there. If you will not do this, you will not get out of out in this. The next one. So for right to use asset, what we will do? Right to use asset will be treated as per IAS 40 or as per IAS 16. We have to see whether this right to use asset, if you have taken a property on lease from me today, you will see whether that property you are using for business purpose or you are using for renting it out. But as mentioned in your exam, most of the time the asset which you take on lease or the building which you take on lease will be under IAS 16 only. If it is IAS 40, the depreciation will be charged in investing category. If it's IAS 16, where will you charge? In operating category. Now see now what, how we will depreciate now. Asset is measured at its initial cost less accumulated depreciation less accumulated impairment loss. The normal accounting, as you do the accounting for IAS 16, same cost model or revaluation model, that depends upon the class of the asset. So depreciation is calculated as follows. How is the depreciation calculated? So we have to see here. If the lessee will take the ownership of the asset at the end of the lease term, then the depreciation should be based on useful life. If the lessee will retain ownership, then depreciation should be based on useful life. If there is no reasonable certainty that the lessee will obtain the ownership, then the depreciation should be at lower of two things. Lower of two things is what? Useful life or lease term. If ownership is retained, ownership will be transferred to the lessee, useful life. If ownership will not be transferred, the lessee will record depreciation at shorter of two things, useful life and lease term. So if the underlying asset belongs to a class of asset that is revalued, the lessee may choose to apply revaluation model. And where will the revaluation gain go? To OCA. If it's revaluation loss, to P&L. If the underlying asset is an investment property and the company is following under IAS 40 fair value model, then the difference of fair value will also be considered for the right to use asset, and it will be recorded in the P&L under investing category. So see the presentation, we show non-current asset, under that we show right to use asset, and in P&L what we show depreciation. If it's IAS 40 investing category, if it's IAS 16 operating category. So with this, we have completed the accounting for lessee. I hope to everyone this is clear. Then coming to the next one, right? Then coming to the next part known as recognition exemption. That means the lessee can opt to either choose to apply IFRS 16 or the lessee can record normal expense. So see now, the lessee can elect not to apply IFRS 16 for what all? If it's a short-term lease, that means the lease is less than 12 months or equal to 12 months, or the lease of low value item. The lease, the asset which you're taking on lease as a lessee is of a low value item. This low value item is not defined by IS and IFRS. It depends upon the judgment of the company. It is based on the judgment of the company. They'll say, okay, for us, if the value of the asset is more than $10,000, it's a high value asset. If it's less than $10,000, it's a low value asset. Very important for MCQ questions. So what are the examples? Tablets, telephone, laptops, second hand car, etc. A lot of examples are there. So now what should we do, sir? If it's a short term lease, that means the lessee will not record right to use asset and lease liability. The lessee will do what? The lessee will record expense on a straight line basis. Short-term lease is a lease at the commencement date has lease term of 12 months or less. The lease term should be 12 months or less and does not include any option to purchase. It should not have any option to purchase, or the lessee should not have the right to extend the lease. Then only we will say what it is a short-term lease. In case of short-term lease, the lease is for 12 months or less than 12 months. In that case, the lessee will do what? The lessee will record the expense on SLM basis, straight line basis, straight line method. Then lease of low value asset. In case of lease of low value asset, IFRS 16 does not defines what is low value asset. Now understand, if today A is there, B is there. B is the lessee. B is the lessee. In that case, B will purchase a tablet. B has taken, not purchase, B has taken a tablet on rent. Now this tablet is taken for 2 years. Now, will the recognition exemption apply? Yes. Even though it's not a short term lease, it is a low value asset. It's not a short term lease, but it is a low value asset. Understand that. So, recognition exemption will apply to this. In that case, if the lessee elects to apply the above recognition exemption, the lessee shall recognize the lease payment as what? Associated with those lease on straight line basis, or any other systematic basis, or any other better way to record it. But most of the time in your question, it will be SLM basis only, or any other method which is more representative of the lessee's benefit. So with this, I hope this is also clear to everyone. The accounting, very important for your exam. Then coming to the next topic known as sale and lease back. In sale and lease back, very important part for FR in MCQ in section B as well as section C. So sale and leaseback, what will happen? Today a seller is there. A seller is selling the asset to a buyer. Why will the seller sell an asset and again take it back on lease? Because the seller is in need of money. It has a liquidity problem. So he will plan what? I will sell the asset. I will get the amount. Then what will the seller do? The seller will take it back on lease. When we take it back on lease, every year we have to do the payment slowly, slowly. But when we sell, we get a huge amount. But when we take on lease, we pay the amount in installment. So now this lessee will sell the asset, and then what will the buyer? The buyer will purchase it. Then the lessee will, the seller will again take this back on lease. So in this case, we say it is a transaction. This transaction will be known as sale and lease back. Now, to be a sale and lease back, very important thing, the control should be transferred. The control should be transferred. That means the lessee should transfer the control to the buyer. Now, what does control means? We have already discussed. Again, we will discuss in IFRS 15. So the seller will do what? The seller will pass the control to the buyer. Then only we will say it is a sale and lease back transaction. In your question, in your examination question, it will be mentioned that IFRS 15 criteria is being satisfied. That means control is transferred. If control is transferred, it is a accounting as per sale and lease back. If control is not transferred, then the seller will record the amount which he received from a buyer as a loan treatment. So if control is not transferred, what we record? Debit, bank, credit, loan. So the asset will not be derecognized. The seller will record the asset and normally depreciate. But the amount which the buyer is giving to the seller will record it as a loan treatment. Now, if I say the control is transferred, in that case, if the control is transferred, that means what? We derecognize the asset at the carrying amount, we record right to use asset, and we record lease liability. And we record lease liability. So now, when you record these three, can I say we also have a gain or loss? We have to calculate that also. Now, see here. If the transfer does qualify as a sale, then the seller, lessee, must measure the right to use asset as the proportion of the previous carrying amount that relates to the right retained. Out of the total carrying amount, how much is the right as a lessee you have retained? The part which is not retained, it has been disposed of. The gain or loss which we calculate in sale and leaseback is what? Is the amount or is the carrying amount of the asset which we have disposed of, which we are not retaining it back. So now how do you calculate the value? See now. So what we do first thing, sir, when we sell the asset, we get what? Debit, bank. Sale proceed will come in. Then what? Credit asset. Asset will go out at the carrying amount. You will remove the asset at the carrying amount. Then what will you record? Credit lease liability. How do we calculate lease liability? Present value of the future lease payment. Present value of the future lease payment. Then what do you do? Then the next thing what we do, we record debit right to use. Now right to use asset you should only record for the part which you have retained. Now how will you calculate that? You have a formula. So see, you will take the carrying amount of the asset, you will multiply with the fair value of the lease liability. Fair value means what here? Present value of the lease liability. Then you will divide it with what? Fair value of the asset. Now in your exam, in your FR exam, every time the sale proceed will be equal to the fair value. Every time the fair value and the sale proceed of the asset will be equal. Understand that? So you get the right to use asset, and if the balance is on the debit side, we have a loss. If the balance is on the credit side, we have a gain. So now see here, so gain and loss, where should we record? If the item which is that, if it's a PP or intangible asset, operating category. If it's an investment property, it will go to investing category. So with this, I hope the accounting for sale and leaseback is clear to everyone. There should be no doubts in this part. So what are the disclosures? We'll give disclosure like what is the depreciation for right to use asset, what is the interest expense, any gain or loss on sale and leaseback, any short-term lease which you have recorded, or lease of low lease of an asset which is of low value. You have to mention this in disclosure so that the users will get to know. So with this, we have completed the revision of IFRS 16. I hope to everyone this is clear. Same yes or no in the chat box. Yes, Ishika mentioned yes. Chalo then. See, time limit is there. We can't do questions. That is the reason. So we will revise only the standard and the mistakes which you do. As mentioned, the mistake that students will do is in the recognition exemption. So if a lease is of a low value asset, the lease term can be more than 1 year. Then also it will be qualified as recognition exemption, and we normally record the expense on SLM basis. We do the total and then we record on SLM basis. So with this is done. Now starting with the accounting, the standard IFRS 15 revenue. So now revenue. So coming to the definition, what is revenue? Revenue is an income. Which income, sir? It's an income which is arising from a ordinary activities of the business. My business is of what? Selling t-shirts. If I'm selling any asset, the asset which I sell and the amount which I'll get, it's not my revenue. It's an income, but it's not a revenue because that is not my day-to-day activity. My day-to-day activity is to manufacture t-shirt and sell. So revenue is what? Income arising from the ordinary course of business. What is a contract? A contract is an agreement between two parties that creates enforceable rights and obligation. That means what? If one party is not fulfilling the obligation, the other party can drag them to the court. Customer, sir, customer is what? Party that has contracted with an entity to obtain goods or service, and that goods or services should be in ordinary course of business. It's not that I'll sell an asset to you. If I sell an asset, you are the customer, but you are not the customer as per IFRS 15. Simple. Now, this standard, your IFRS 15 will not apply to financial instrument, lease contract, insurance contract, which is not there for you, and non-monetary exchange. Non-monetary exchange, exchange of similar goods between entities in similar line of business. In a regular class, we have taken an example that a dealer is there in Mumbai, Bangalore, so he has a customer, etc. We have discussed this part. Now, chalo, let us start with the five-step model in case of revenue. So, see, this standard which we are learning is same as the accounting which you have learned in your class 11th and 12th. What is the difference here? Revenue should be recorded when the obligation is satisfied. Today, if I'm selling my course to you, what is my obligation? My obligation is to deliver lectures. As and when I deliver the lecture, I will record revenue. So the five-step model, which is given by IFRS 15. Step one is what? Identify the contract. Step two is what? Identify the performance obligation in the contract. So the performance obligation in the contract we have to see. Now, if I say we have done a contract, I will provide my lectures to you, plus I will provide the hard copy of my notes. In that case, I have two obligations. One is to deliver the notes to you as well as the lectures I have to provide. So there are two performance obligations. For the notebook, what will I do? As and when I deliver at your doorstep, I will record revenue. But for the lectures which I provide for the 3 months, for a particular attempt, in that case we record the revenue over the period, but in case of book we record in one shot. So step number 3 is what? To determine the transaction price. Transaction price means what is the amount you will receive from the company, or what is the amount the company will receive if the company is recording the revenue. Step number 4, sir, allocate the transaction price. The transaction price which you're getting, the total amount, should be allocated in the performance obligation. Like if you pay the fees, we will allocate to the book, we will allocate to the lectures. Step number 5, recognize revenue as and when the performance obligation satisfied. So either the performance obligation will satisfy over time or at a point in time. Now let us go into detail for step number 1. When will you say that there is a contract? If the contract, to be a contract, 5 important points, all these 5 points should be met in order to be a contract as per IFRS 15. The first one is what? Parties to the contract have approved the contract. Both the parties have agreed to it. Then the entity can identify each party right. That means the rights of each party as a customer and as a supplier should be identified. Then the payment terms can be identified. That means when will the payment be done? How will the payment be done? Either cash will be paid or bank transfer or UPI, etc., credit card, etc., XYZ. Then the contract has a commercial transaction. Very important. If I enter into a contract today with you and it is affecting my future cash flow, then I say it is a revenue, or then we can say it's a contract as per IFRS 15. So commercial substance means which will affect your future cash flow, and it should be probable that the entity will receive the money. If I'm selling goods to one of my friends and I know that he will not pay me only, in that case this is not a contract as per IFRS 15. I will not record this as a revenue. The entity, the it should be probable that the entity will receive the consideration, then only we say it's a contract as per IFRS 15. So now see an important note here which can come in your MCQ. If any consideration is received from the customer in an agreement which is not a contract, okay, it is not a contract as per IFRS 15, but still you have received the amount. In that case, you will record this as a deposit liability. You will record this as a liability. Now, sir, can we record this liability as an income or a revenue? Yes, you can record this as a revenue when the company will deliver the goods and services and the amount will not be refunded. Let's take you have given the amount today to me and it's not a contract as per IFRS 15. But can I record this liability as a revenue in future? Yes. Once I deliver the goods to you and I will not refund the amount to you, I can record revenue. Or the contract is terminated and consideration received is non-refundable. This is in case where you pay token amount. You pay some token amount to book a flat. After 2 months, you say that we do not need this flat. The broker will say that we will not refund this token amount. In that case, for the broker, the token amount will be recorded as a revenue. So very important point from MCQ. So with this, we have completed the step number one. Step number one, we have seen to identify whether it's a contract or not as per IFRS 15. Now step number two, sir. Step number is two is what? To identify the performance obligation. To identify the number of obligation in the contract. The number of responsibility which a company has in relation to a contract towards a customer. So now, see here now. To check whether the number of obligation, you have to see whether the goods or service are distinct or not. Distinct means what? We will come to this definition. Now, understand. Goods or services are distinct. In that case, entity will recognize the revenue when the control is transferred to the customer. As and when control is transferred, we record revenue. Or a series of distinct or service goods or services that are substantially the same pattern. In that case, revenue will be recorded over the period. And this will be treated as a single performance obligation. Let's take the example. Like you do the recharge for your mobile phone, you pay for the full year. If you pay 4,000 rupees, that means you will say, sir, Jio or Airtel has everyday obligation. In a basic sense, we say there are 355 obligation. Each day it's an obligation for Reliance. But can I say it will become too complex to do the accounting if the goods or services which are transferred are of same nature and the way they have transferred is the same. In that case, we say it's a single performance obligation. You will not say that, sir, it is 365 obligation. Every day it's not an obligation. The company will say it's a single obligation and the revenue will be recorded over the period, like cable service, phone recharge, security service, etc. XYZ. So now coming to the note, meaning of distinct. How will you identify whether the goods or service are distinct or not? If it's distinct, then we record it as a separate performance obligation. What does the term distinct means? Customer can benefit from the goods or service on its own or with any other readily available resources with the customer. That means if the customer has done a transaction with you, today the customer has purchased a machinery. Let's take with this machinery, he has also purchased 3 years maintenance contract. So can I say your machinery is also there and 3 years maintenance contract? So as of now, we can say these are two performance obligation. That means what? The customer can take the benefit of the machine and he can go to the market and purchase the maintenance contract from someone else also. So we say that there are two performance obligation. Customer can benefit if this comes in your MCQ. A tricky part. What should you see? Whether can the customer purchase these goods in separate in the market. If they can purchase separately in the market, then we say the customer can take the benefit. The other thing, and it's and here in between it is and you have to satisfy both the condition. The second condition was the promise to transfer the goods or service is separately identifiable. It should be mentioned in the contract that we are providing a machine also and we are providing what maintenance contract. That means it is identifiable in the contract. Then we say that both the this machine and maintenance contract are separate performance obligation. The revenue for machine will be recorded at a point in time once I deliver the machine to you, and this maintenance contract I will record revenue over 3 years. So now see, to be identifiable, there should be no significant integration, there should be no significant modification, the goods or service should not be interrelated. So if a question comes, very tricky question comes in the exam, will be from these 3 points only, not more than that. That means to be identifiable, we say that there should be no integration between the two activities, there should be no significant modification, the goods or service should not be highly interrelated or interdependent. This you can see significant modification you can see in intangible asset. When you purchase an intangible asset, if I am selling an intangible asset to you, as well as I say I will modify this intangible asset as per your needs, in that case The service which I'm providing for modification and the intangible asset will be one performance obligation. It will not be a separate performance obligation. So this was the discussion regarding step number 2. If a promise to transfer a goods or service is not distinct from other goods or service in a contract, they are combined as a single performance obligation. With this, your step number 2 is done. Step number 3. Now coming to this step number 3, very important for calculation perspective for FR. So what is the transaction price? Transaction price basically means the amount which the company will receive from the customer. So what are the transaction price component? We will cover fixed consideration, variable consideration, significant financing component, non-cash consideration, customer provided goods or customer provided goods, consideration payable to customer. Now see the first part, fixed consideration. Now what does fixed consideration mean, sir? It is the fixed amount mentioned in the contract. If I mention today that I want to construct my house, I have given the contract to you. I say that you will charge me 10 lakh rupees. That means it was mentioned in the contract. This is the fixed payment. So variable payment means what? Variable payment means it depends on some outcome or some future event. I say that if you complete my house within 1 year, I will give you an additional payment of 1 lakh. If you complete my house within 1.5 years, I will give you 80,000. If you complete my house within 9 months, I will give you 2 lakh rupees. So this amount or the extra amount which I'm quoting you is a variable consideration. You also you have to estimate whether you will receive that or not based on the past activities or the past experience, whether will you be able to complete the project within 1 year, within 9 months, or it will take more than 1.5 years. So see now, variable consideration, an amount of consideration would be variable if either a product was sold with a right to return or a fixed amount is promised as a performance bonus on achievement of a specified milestone. If you achieve something, we will pay you. Now see here, variable consideration may be fixed in amount, but the entity's right to receive that consideration is contingent on future outcome. The amount is fixed, I mentioned 2 lakh, 80,000, 1 lakh, but this depends on the future outcome, whether you will be able to complete the project within time or not. In that case, you will estimate, you will say, sir, we'll be able to complete within 1 year. In that case, your transaction price will be how much? 10 lakh plus 80,000 because you're completing within 1 year. If you're taking 9 months, then it will be 10 lakh plus 2 lakh. Understand? So, sir, variable consideration, MCQ, very important for MCQ. Variable consideration will be part of the transaction price to the extent it is highly probable that a significant reversal will not happen. When you do the estimate should be a best one so that in future there should be no reversal. It's an estimate and it should be based on high probability. You will say that, sir, we know that 90% we are sure that we will complete the project within 1 year. Then you will include what value? You will include 80,000. If there is a surety that it is 30% only, then do not include. Now see, to estimate the variable consideration, there are two methods. Expected value method, most likely method. So most likely method when we will use when there are one or two outcomes. When there are one or two outcomes, we will use most likely method. Expected value method we will use when there are more than two outcomes. If there are more than two outcomes, you will use the probability. You will use the probability. See here, I have taken an example. If you construct my home, fixed payment is 40,000 and transaction price will be fixed plus variable. So this will be based on expected value method or most likely method. So in most likely method, only two outcomes. I have mentioned two things. 10,000, 7,000, and the probability is 80% and 20%. Then here outcome depends upon the probability. I've given you a lot of options, 7 months, 8 months, 9 months, 10 months, 11. In that case, you will decide. So 10,000 into 50%, it's 7,000 into 30. You will take the probability and you will include 8,700. But here you will consider straightforward 10,000. This is expected value method. Same method we will use in IAS 37 provision to estimate the value. And then most likely method. This is the thing which we have done. So this is clear to everyone. So fixed payment is clear and variable consideration is clear. Now coming to the next part. The next part is what? Significant financing component. So this will also come in your exam for 1 or 2 marks, not more than that. That means let me take an example. Today Havels is the seller and I am the customer. Today I purchased a TV from Havels and I say that I will do the payment after 2 years. So what I say, today I purchased a TV from Havels. Havels have delivered the TV today to me. In that case, can I say the control is with me now? So revenue, Havels will record the revenue today only, but in today the market value of the TV is 10,000, and will, and you are doing the payment after 2 years. If you're doing the payment after 2 years, if you're doing the payment after 2 years, will Havel say you to pay 10,000? No. Havel will say to pay you more. It will be 12,000, or it could be 13,000, 14,000, based on the inflation in the market, etc. Why? Because of opportunity cost. If you have covered your PMFM, you will know this concept. If not, just a simple point is that today, if I'm selling an asset and you're paying after 2 years, I'm not a fool to sell you an asset whose value to sell a goods whose value is 10,000 today, and you make the payment after 2 years, that also 10,000. I say that you are paying after 2 years, I need some additional amount. That additional amount will be an interest income for me. For me, it will be an interest income. For you, it will be an interest expense. See now. Sale is done on day one, payment is after 2 years. So today market price, today the price of the TV is 10,000. After 2 years, you'll make 10, 12,000. So on the day one, revenue is record, debit, receivable, credit, revenue. Why? Why? Because today the TV has been transferred to the customer. Then at the year end, what will Havels do? Havels will record interest income. They will increase the receivable by 2,000 and 2,000. And this is for how many years? This is for 2 years. Understand? I have recorded for 2 years. So this, where it will be recorded? This will be recorded in operating cost, operating category. See, normally this should go to financing category, but you will be recording this in operating category. It is specifically mentioned on a ACCA study. So follow that on. Whatever ACCA has mentioned, please follow that on. So you'll record this in operating category because we say it is related to the business activity. So we record in operating category. Then what? At the end of the year two, the company will receive the payment. Havels will receive the payment. So cash, they will receive 12,000. They will remove receivable of 12,000. So this was the case of what? Today the goods are provided, but the customer is paying in future. Now the other way. Today what? Havels is receiving the payment, but the TV is delivered after 2 years. The TV is delivered after 2 years. So now when should Havels company record revenue? Havels company should record revenue after 2 years, because the TV is being transferred after 2 years. So see, day one, debit cash, credit contract liability they record, because it's a liability, 10,000, 10,000. Then for the 2 years, what will the company do? The company will record this as an interest expense. They'll increase the value of the contract liability. Why contract liability? Because this has not been earned. So debit interest, credit contract liability, they will record, and they will say this will go to operating card, operating category as an expense. So then at the end of the second year, what will happen? The company will record it as a revenue by removing what? The contract liability, because they have earned the income. So transaction price should be adjusted for financing component. Then significant financing component will exist when the time gap between the delivery of the goods and service and the payment date is more than 12 months. It is more than 12 months. Note, revenue should be recognized when control of the goods or service are transferred. When you transfer the goods or service, we record it as a revenue. Revenue should be recorded at cash selling price. Revenue should be recorded at what? Cash selling price. Cash selling price means the day control is transferred. The day when the control is transferred. Now, what is the discount rate we use? Here, the discount rate we use the incremental borrowing rate, and then we give the priority to implicit interest rate. In your exam, it will be specified if this question comes. What is the interest rate to use? So with this, we have completed the significant financing component also. Then coming to the next one, non-cash consideration. Now, non-cash consideration means what? Let me open the class notes so that it will be better revision for you. So see you now. So see now, non-cash consideration. So in case of non-cash consideration, what will happen? That means today what is happening? A is there, B is there. B is selling goods to whom? A is selling goods to B. So let us take an example. A is selling a Rolex watch. A Rolex watch A is selling to B. Now B is saying that we will not give the payment as we do not have money. But B will say what? I have a Gucci bag. And this Gucci bag is also having a very good value in the market. In that case, this can I say A is selling a Rolex watch and they are receiving a Gucci bag. In that case, A company is recording. For A company, can I say this is a revenue? Why? Because they are selling Rolex watch and it's their main business to sell watches. Now what is the transaction price? What is the amount of revenue you will record for Rolex watch? Here can I say it's a non-cash consideration? Cash is not involved here. One part is given Rolex watch, the other part is giving what? Gucci bag. In that case, A company will record revenue for Rolex watch based on what's here now. Sometimes the customer promises to provide to pay for a goods or service in a form other than cash, such as shares, equipment, or advertising. In that case, to determine the transaction price in such case, preference. First preference should be given to fair value of the non-consideration received. That means the fair value of the Gucci bag. The fair value of the Gucci bag will be what? The transaction price or will be the value of revenue for Rolex watch. Yesterday when we discussed IAS 16, we had mentioned the exchange of asset. There it was fair value of the asset given. Here it is the fair value of the asset received or the item received. If the fair value of the Gucci bag is not available, then we'll consider what? The fair value of the Rolex watch only. We'll consider the fair value of the Rolex watch. This Rolex watch fair value will be what? Standalone selling price. Standalone selling price. So the first preference will be given to what? Fair value of the non-cash consideration received. These all are very important for theory as well as calculation. So with this, we have completed this part, non-cash consideration. Then the next one, customer provided goods or services. Now, what is the next case we are doing? Customer provided goods or services. Sometimes what will happen? No, I say a thing to you. I want to construct my house. I have given the contract to you. I have given the contract to you. If I give the contract to you, can I say in your books it will be a revenue? In your books it will be revenue. So now when you record the revenue, I say that you are constructing my house. My business is regarding cement business. I have cement business. The cement is a raw material which is required for the construction of the house. I say that cement I will provide to you. I will provide the cement to you, so that this cement only you should use. This cement only you should use to construct my house. So in that case, what will happen? Customer provided goods or services. If customer contributes goods or service, example material, equipment, to facilitate an entity's fulfillment of the contract, the entity shall assess whether it obtains control of that or not. So see here now, if you remember in the class we had taken the example of gold chain. Now AM Limited, M Limited is a company. M Limited was a company. This N Limited has a gold business. Now Raju is there. Raju is a customer. Raju needs what? Raju needs a gold chain. Raju needs what? Gold chain. Now Raju needs a gold chain. Raju, what did Raju do? Raju had a old chain which belongs to his grandparent. So we have brought this old chain and given to M Limited. And Raju mentioned to M Limited that this gold chain which I have given to you, from this gold chain only melt it and remake or make a new chain. In that case, can I say Raju is saying that I will either give you a gold bar, gold biscuit, or I will give you what? I will give you a gold chain which belongs to my grandparent. And this gold only you should use. This gold only you should use to make my chain. So now here there are two things. One is what? Raju will give the gold biscuit and Raju will say you should use this biscuit only to make the chain. Or Raju will say, Raju will give a gold biscuit. Raju will never say, I need just a chain. So there are two things. If Raju is saying that I need the gold chain from this biscuit only, that means control is not transferred. Control is not transferred. But if Raju is just giving the gold biscuit and nothing is saying, it's okay, you give me chain. In that case, the control is transferred. So see now here. If entity obtains control, that means if entity obtains control, then what we do? Fair value of the goods or service supplied by the customer will be added to the transaction price. That means whatever is the gold biscuit which Raju has given me, I will include that in my fair value of my transaction. If entity does not obtain control, that means Raju is saying that you should make the gold chain from this biscuit only. In that case, Raju is not transferring the control. In that case, the company will only record what? The making charges as a revenue. So fair value of the goods or services by the customer will not be added to the transaction price. It will not be included in the transaction price. Understand? The fair value of the gold biscuit, only the making charges we will record it as a revenue. So with this, we have completed this point also. Then coming to the next one, consideration payable to a customer. Now, why will a customer consideration payable to a customer? Today, I say that I am the entity, you are the customer. Today, you have given me $10,000 because I have supplied some goods or service. I say that I will pay you back 1,000. I say that I will pay back 1,000 to you. In that case, what is happening? The consideration is payable to a customer. I will record revenue in my book. I am transferring what? I am giving you cash here. In that case, what will happen? See, consideration payable to a customer. See here now. In this case, if the consideration is payable, we have to see two important things. Understand, you will be my customer, I can be your customer. You are my customer, I can also be your customer. If you have your own business, I have my own business. I will be your customer, you will be my customer. So if this is the case, this concept will apply. Understand? Now the amount which is that I am repaying you back 1,000. Now the amount which I pay back to you 1,000, I am not purchasing any goods or service from you. I am not your customer. I am simply repaying you. If I'm simply repaying, that means I'm giving you a discount. I'm returning the amount. In that case, account for the consideration as a reduction of the in the transaction price. Totally, you gave me 10,000 and I'm giving back you 1,000. Excuse me. So my transaction price should be 9,000 because the 1,000 which I gave is not relating to any goods or service which I purchased from you. But if I say, I purchase some goods or service from you, then it will not affect the transaction price. The transaction price will be 10,000 only. What will I do with this 1,000? I will record this 1,000 as a purchase. I will record this as a purchase, a separate entry only. There will be no link with this. So with this, I hope this is also clear to everyone. Any doubt still here? Semi. So both the points we have covered in detail. Now coming to the next step, step number 4, a very important part. You have to allocate the transaction price. So see now, allocate the transaction price to each performance obligation or distinct goods on a relative standalone selling price. Standalone selling price, SSP. SSP means standalone selling price. What is the market price for each asset or each item? So standalone selling price, the price at which an entity would sell a promised goods or service separately to a customer. If I mention that we have done a contract and we are providing the classes for 8,500, and normally in this 8,500 you are getting what? You will be getting book, the handwritten notes, plus you will be getting the lectures and then mock evaluation, etc. A lot of things. In that case, a lot of performance obligation is that. In that case, that 8,500 we will do what? We will allocate it to book, we will allocate to lectures. On what? I normally sell my book for 1,000 and we normally sell lectures for 9,000. So this is my normal selling price. But when we provide this, we provide it at a discount of 8,500. So the discount which we are providing, the discount should be allocated to the book and it should be allocated to the lectures. Understand that? So yes, if sometimes this can come in your MCQ, we have one or two MCQs also regarding this. If standalone selling price is not available, sir, we don't know what is the standalone selling price, then you will use your competitor's price. If you do not know what is the selling price, use the competitor's price to allocate the transaction. If that is also not available, use what? Cost plus margin approach. Whatever is your cost plus the margin, the profit which you earn. If that is also not available, then residual approach. Residual method means what? Today you paid 10,000. Out of that, 3,000 relates to one, 4,000 relates to one. The remaining will what? 3,000. That will belong to product C. We can, this is A, this is B, and this is C. This is known as residual approach. CM. Allocation of a discount. Discount should be allocated to each and every product. So let us see an example here. Entity sells three distinct products A, B, C at 10,000. The customer to the customer. So product, the SSP is given here. For A, B, C, the SSP is 5,000, 4,000, 3,000. So the total is how much? 12,000. But the customer is paying 10,000. That means 2,000 is the discount, which is that. This 2,000 discount belongs to A, B, and C. We have to allocate. See now, A, for A, 10,000 you will take into 5,000 divided by 12,000. For B, 10,000 into 4,000 divided by 12,000. For C, 10,000 into 3,000 divided by 12,000. So you get the standalone selling price. I hope to everyone this is clear, the allocation of transaction price to the performance obligation. You have one more case. This is not tested, so will not do. If you want, you can refer the notes and see. In our regular classes, we have done this. If there is a variable consideration in a transaction price, then only allocate to that product or to that performance obligation. If there is a variable consideration relating to product A, then only include that variable consideration to product A only after the allocation. So with this, step number 4 is done. A very simple and straightforward calculation. Step number 5. Now coming to the most important part. Step number 5. We should record revenue. When should we record revenue? Revenue will be recorded when the performance obligation gets satisfied. So see, an entity should record revenue when the performance obligation is satisfied. So when will you say performance obligation is satisfied? When the control is transferred. So control means what, sir? Today, if I'm selling iPhone to you, when will I say that I have transferred the control to you? When you have the right to use the iPhone. However you want, you can use. Whatever the benefit which you get from iPhone will belong to you. Whatever are the risk of the iPhone will belong to you. Everything will belong to you. In that case, I say I have transferred the control. See, you have the right to take all the benefits and you have the ability to pretend others to use the asset. Now you will be using that asset. So what are the some other indications which comes in your MCQ question? See here now. Entity has a present right to the payment. If I have delivered the iPhone today to you, that means what? I have the right to receive the payment from you. In that case, if I know that I have the right to receive the payment, control is transferred. Second one, customer has the legal title of the asset. That means legally the asset belongs to you. We have done a sale invoice and the bill I have given to you. That means legally the asset belongs to you now. Then the entity has transferred physical possession. That means physically I have given the asset to you. That is the iPhone. Or the customer has significant risk and rewards. Now, if the iPhone is not working properly, if it has been damaged, etc., all the risk will relate to you. Nothing will be related to me. Everything will be related to you. In that case, I say I have transferred the asset. Or the customer has taken the asset. The customer mentioned, okay, that the asset belongs to me. In that case, we say what? The control is transferred. So transfer of control. Transfer of control can be over a period of time or at point in time. If it is at point in time, what we do, we normally record revenue today. Now, sir, how to identify it over period of time, at point in time? Three conditions are there. Out of these three conditions, if any one condition is being met, we say what? We say what? Revenue should be recorded over the period of time. So the first one is what? Customer simultaneously receives and consumes the benefits. Like your phone recharge, as Reliance is performing, you're taking the benefit. For me also, as I'm performing, as I'm giving lectures, you're taking the benefit. So as I'm taking the lectures, you're consuming it and taking the benefit. The other, entity performance creates or enhance an asset. In the case of construction business, if I give an asset, if I say that I have to construct my house, I have given to you to construct my house. Can I say, as you're doing the construction, for me, the asset value is increasing. My value of the house is increasing. So it's an asset for me. So as the company performs, it creates an asset for the customer. In that case, also we say revenue should be recorded over the period of time. Then the third condition, which is very important, asset being created does not have any alternative use. That means what? Let's take the example of satellite. It's your business. I want you to develop a satellite for me. And that satellite is very unique. In that case, that satellite which you're developing for me, it's very unique and no one else in the market will be able to use. In that case, you will take the risk. You will take the risk to manufacture the satellite, and the satellite will take 1 year or 2 years to be developed. In that case, you will record the revenue over the period because The asset here is unique, and you will say what? You will say that you will have the right to receive the payment of the work you have completed. Asset being created does not have any alternative use to seller, and on cancellation, entity has the right to payment for the performance completed today. After 1 year, I say that I do not need this satellite, but you will say what? Whatever cost we have incurred, please give us back that amount with some profit. You will have the right, even though if I'll not take the asset, you will still have the right to take the payment from me. In that case, we say revenue should be recorded period over a period of time. So with this, I hope to everyone this is clear, the transfer of control case. So now the next important thing, sir, how should we record revenue in case of over the period? If the revenue is recorded over a period of time, in that case, how should we record the revenue? There are two methods. The favorite question of the examiner in section B as well as in section C for single entity. So there are two methods, input and output method. So input method, in this case, we will use what? What are the resources we are using? We will consider the resources which we are using. On that basis, we will calculate the percentage of work done. Output method will be the value of the work. What is the fair value of the work which you have done? Data will be given. Just remember the 4 steps and do the calculation. You will get the right answer. So in input method, what we do, whatever is the cost we have incurred till date. So I say that I have incurred $10,000 today, divided by total estimated cost. Total estimated price means to complete the project. That is cost incurred till date plus in future how much is the cost I will incur further to complete the project. It's input method. For output method, what we do, we'll take the total contract price, and we take work certified. What is the value of the work and divided by the contract price. You get the percentage. So here see now, what is the step number one? Step number one is to calculate overall profit or loss. If it's a profit, no issue. So how do we calculate? Contract price less cost incurred till date less cost to complete. That means future cost. You'll get whether the contract is in profit or loss. If it's in profit, very good. If it's in a loss, then what should we do, sir? If it's in a loss, we should record the loss today only. If you can link this in IAS 37, you have learned onerous contract, and this will have a linkage. So we'll record this as a cost today only. We create a provision. Step number two is what, sir? Determine the progress of contract. Input method, total cost incurred till date and total expected cost. Output method, work certified divided by contract price into the percentage. Step number three is what? Step number three is to calculate the revenue and cost of sale. Revenue will be what? Contract price into the percentage of completion, which we have calculated in step number two, less revenue recognized in previous year. What is the revenue you have already recognized in previous year minus that, because this percentage works on a cumulative basis. That means today I say I have completed 20% work. Next I say till year 50%. That means for the first year the revenue should be 20%. For the next year 30% only will be the revenue. So you reduce the revenue which has already been recognized in the previous year. Cost of sale will be what? What is the cost which the company has incurred in the current year? In output method, what we do, work certified till date. That means what? Either you can use the contract price into the percentage, or directly you can write work certified minus revenue recognized in previous year. So you'll reduce this, you will get the revenue, and cost of sale will be what is the actual cost incurred in the current year. So the step number three is done. Step number four, very important. You should calculate contract asset or contract liability. Contract asset basically means what, sir? Contract asset will arise when the entity has performed the work, but the entity has not yet received the payment. Entity has done the work, but they have not received the payment. When will contract liability come into picture? Contract liability will come into picture when the entity has received the payment, but the work is not done. See, contract liability arises when an entity has invoiced the customer, received payment, but not yet worked. Work has not been done. Contract asset, contract asset arises when the entity has worked, but they have not yet received the amount or they have not yet invoiced it. So in your exam question, either the amount that is received will be given or the amount invoiced will be given. It should be given amount invoiced only. The question will not say you the amount paid or received, etc. It will be given as amount invoiced. So first you will take what? Revenue recognized to date. Here there is a difference. It's to date. To date means till today when you started this contract, till date cumulatively what is the revenue. You'll consider that minus amount invoiced. What is the amount which you have invoiced cumulatively till today? You will take that. If it's a positive number, we say what? It is your asset. If it's a negative, it's a contract liability. And where will you record this contract asset, contract liability? In your balance sheet under current asset and current liability. So see now, if the expected outcome is a loss, the whole loss should be recognized immediately and balance sheet should be and balance shall be recorded as a cost of sales. So debit cost of sale, you will increase the cost of sales and you will do what? You will create a provision. This you will have a linkage with onerous contract. Onerous contract in your IAS 37. So now one more important point which comes in your exam. Sometimes what will happen, you will not be able to calculate the percentage. If you're not able to calculate the percentage, then the revenue will be equal to what? Revenue should be recognized only to the extent of the contract cost. That means revenue will be recognized to the amount which you have already incurred, and the amount which you have incurred, and it should be probable that you will recover that. So today I say that I have incurred $10,000 on this project. I'm not able to identify the percentage. I know the contract price. My contract price is, let's say, 20,000, but I'm not able to calculate the percent. In that case, my revenue will be equal to the cost which I've incurred till date, and it should be probable that I will receive this amount. If I say I will only receive 8,000, then I will record 8,000 as my revenue. I will not record 10,000. So with this, we have completed this part. So with this, your step 1, step 2, step 3, step 4, step 5 is done. Any doubt still here? Chalo, say me. Others? No doubts. Okay, chalo. Now coming to small areas which are frequently tested for MCQ in FR exam. Principal and agent. A principal will record the revenue on what? Gross basis. An agent will record the revenue on what? Net basis, that the commission which they receive. The notes I've shared in the group. Message me again, I'll share these notes. Or someone else, if someone has the notes, please share. So now principal versus agent. In that case, what should we do? Principal will record the revenue on gross basis. Agent will record the revenue on net basis, only the commission. Now, sir, how we will identify whether the company is a principal or agent? Simple indicators, 3 important indicators. The entity is primarily responsible to fulfill the contract. Now, the entity has the responsibility to fulfill the contract. Then we say it's a principal. The entity has the risk of inventory. The inventory has the risk of the inventory belongs to this entity. If I say entity A is there, B is there. Entity A has the responsibility to fulfill the obligation regarding the contract. The risk of the inventory also belongs to entity A. Entity A has the right to set the price. Entity A has the right to set the price. These all will indicate that company A is the principal. So principal will do what? Principal will record the revenue on gross basis. An agent will record revenue on net basis. But this principal will pay the commission to this agent. Yes or no? This commission will be recorded as an expense. It will not be reduced from the revenue amount. It will be recorded as a separate expense. Understand? In a MCQ question, do not do this mistake. So with this, we have completed what does principal and agent means. Then coming to the next thing, sale with right to return. That means company is selling you goods, but the company has given a right to you to sell. Today I'm selling goods to you, but I've given the right to you to return it back. Like your Amazon, etc. They give 7 days, 10 days, Mintra, or they give 10 days period to return back the goods. In that case, revenue, how will the revenue be recorded? So just see now an example which I take. Amazon sold 10 iPhones to Rahul for 2,000 each. So what did the iPhone cost? Amazon is selling 10 phones to me. Each cost is how much? 2,000. Cost of phone was how much? 10,000. The revenue, which company will record the revenue? Amazon will record the revenue. There is a 30 days return policy. Okay, Amazon has given me 30 days return policy. Whenever I want, I can return the iPhone or phone within 30 days. Amazon Amazon says that based on the past data, we have seen that this customer or Rahul will return three iPhone or three phones back. In that case, what should Amazon do? Amazon should record revenue on what basis? Amazon should record revenue only for seven iPhones, because we have learned the concept of variable consideration. Variable consideration means the amount of revenue should only be included to the extent that in future there should be no reversal. So the company has a doubt regarding these three iPhones, so they will not record it as a revenue. So even though the company will receive 20,000, that is 10 into 2, 20,000, but the revenue will be recorded for only seven iPhones. For the remaining three, what will the company do? The company will record as a refund liability. Refund liability. But the company would have done what? The company would have recorded the cost of goods sold for how many? The company would have recorded normally the cost of goods sold for 10 iPhones. So the company will do what? On the same day, the company will say that we have a right to receive the asset back. They will say we have the right to receive the asset back within 30 days, and they will decrease the cost of goods sold, because revenue you are recording for seven products, but the cost you are recording for 10. It's not correct. It should be like with like. So what we do, we record what, sir, we reverse the cost of sales and we record a right to receive asset. This is clear to everyone. Now after 30 days, what can happen? After 30 days the phones are returned. If the phones are returned, what will the company do? The company will simply pay back 6,000. Amazon will pay back 6,000 and remove the refund liability. And what they will do, they will reverse this entry also. Why they will reverse this entry? Because they will increase the value of the, they'll increase the value of closing inventory. The next one, if the phones are not written, if the phones are not written, then what will the company do? The company will record it as a revenue. So debit, refund liability, credit, revenue, they'll record. And what will they do with this entry? They will reverse it so that the cost of the sale is increased. Cost of the sale is increased. I hope this is clear to everyone. So with this, we have completed the concept of sale with right to return. Then coming to warranties. Again, one more small topic in IFRS 15. There are two types of warranty. The first one is what? Assurance warranty. The second one is what? Service warranty. Assurance warranty is also known as what? Standard warranty. This is also known as what? Standard warranty. Now this assurance warranty will be treated as per IAS 37. A provision will be recorded. A provision will be recorded. Why a provision will be recorded? Understand. Because this is as per the requirement of law. If you want to purchase iPhone today, so what will you do? You will go to the store, you purchase iPhone, 1 year warranty you get. That 1 year warranty is known as assurance warranty. If you can purchase additional warranty, the store will say what? The salesperson will say, sir, you can pay 2,000 extra and we can give you 2 more years. For 2 years, for further 2 years, we can extend the warranty. Then for the further 2 years, when you're doing a payment to extend your warranty, will be treated as per IFRS 15 as a separate performance obligation. This will be treated as a separate performance obligation. Separate performance obligation. So this will be treated as per IFRS 15. And what will you treat for assurance warranty? Assurance warranty will be treated as per IAS 37. IAS 37. I hope there is no doubts to anyone regarding this topic. Then coming to contingent consignment arrangement. So now consignment arrangement, let me take an example. All these are very important from the theory point of view. In our regular classes, we have done a lot of questions. So see, consignment arrangement. Understand this. Now see, we have taken the example. We'll take the same example. Raju is there. Raju is in Russia and Raju is a don. Raju deals in drugs and he supplies drugs all over world. Now a person is there in India, and yes, a named person in India, he needs what? Drugs. He needs drugs. I'm just taking an example. Understand. Raju is in Russia, Yash is in India. And Raju is what? Raju is selling drugs all over the world. And Yash is in India. Yash needs the drug. Now Raju will supply directly to Yash? Never. Raju will supply to some third party in India. Let us take that the person name is X here. So now you only say Raju will do what? Raju will say this person X to take care. But you only say Raju will be happy when? Raju will be happy when the drugs are delivered to Yash, or the item is delivered to Yash, a asset or anything it could be. In that case, can I say Raju will record revenue when the item is delivered to Yash, the asset is given to Yash? In that case, can I say Raju will not record the revenue once it is delivered to this person in India? Because if Raju says that this person will not pay me, so Raju can say what? Raju will say this person, okay, do not provide these goods to Yash. I say to some other party, deliver the goods to some other party in that case. So here there is a mediator person. In this case, Raju will only be able to record revenue when the goods are delivered to the ultimate customer. So this is a type of a consignment arrangement. So see here, no? So what are the indicators? This will work with your car companies. Like you have showrooms, no? Your manufacturer is the Maruti Suzuki. There are a lot of showrooms or distributors. In that case, this will apply this concept. So what are the indicators, sir? The entity controls the product until a specified event. Even though today I have given the goods to you, but will I record revenue? No. I will say that the goods which I have given to you, you have not done the payment. I say these goods which I've given to you, I can collect these goods anytime, whenever I want, or I can say you to deliver these goods to some other party. In this case, the control is not transferred. And you also will say what? We will not make the payment to you until we sell to some customer. These all are the indicators of consignment arrangement. Even though the physical possession is with you, the asset is with you, I have not transferred the control because I have the right to take it back from you. Or I can say you to transfer this to someone else. Or you say that, sir, we will not do the payment until we sell to some customer. Revenue is recognized when control get transfers. Revenue will be recognized when control get transferred. So with this was the concept regarding consignment arrangement or agreement. Then coming to the next other topic, bill and hold arrangement. So bill and hold arrangement. Let me take the example. With the example, it will be easy to understand. So now see a bill and hold arrangement. I'm not given an example, but it's very easy. See here now. Ah, here. Here example is that. See now, R Limited is there. R Limited is selling goods to Raju. Raju needs a lift for his house. So R Limited is selling a goods to whom, sir? Raju, and Raju needs the lift. Today, R Limited has the lift. They are ready to transfer. But Raju will say what? Raju will say to R Limited that I am out of the station. Now I'm not at home. So once I come back, I will take the asset from you. That means what? R Limited is what? R Limited is selling the item to Raju, but the lift is with R Limited only today. The lift is with R Limited. In that case, can R Limited record revenue? Yes, R Limited can record revenue still when the conditions are being met. What are the conditions? See now. R Limited will be able to record the revenue even though the lift is not transferred to Raju. Why? Because Raju is saying that I am out of the station. So please keep the lift with you. As I come back, I will collect from you. Now R Limited can record the revenue when three conditions are satisfied. So what are the three conditions? See now. Customer has requested this. That means this is requested by the customer. Raju has requested this. Product must be identified separately. That means R Limited should keep this lift separately in their warehouse when compared to other lifts. The product currently must be ready for physical transfer. That means the product should be transferred physically to whom? Raju. Raju mentioned that I will come after 1 month back and collect the lift. But after 2 days only Raju is coming to collect the lift. That means in that case the asset should be available to transfer immediately whenever the customer mention will come after 10 days, but the customer can come after 2 days also. If he's coming after 2 days, the asset must be available. Then fourth, entity cannot use or sell the product to other customer. That means the entity cannot use the asset for their own purpose, or they cannot sell this to anyone. In the If these four criteria are being met, we say it's a bill and hold arrangement, and the revenue can be recorded today even though the asset is, or even though the item is with the R Limited. So this was the concept regarding bill and hold arrangement. Then coming to the next, concept known as repurchase agreement, where you would have seen a lot of MCQ. So what is this repurchase agreement? See here now. Repurchase agreement means what? Basically, today I sell an item to you, but I say that in the contract I've written that I will purchase back from you. In that case, this is a repurchase agreement. I sell, I take back. See here now. If I say the repurchase price is more, if I say repurchase price is more, I am selling an asset today to you at 10,000, but I purchase this back from you at 12,000. In that case, this, if you see the substance over form here, on the legal papers, you see it's a revenue, but when you look to the actual case, what is happening? It's a financial liability, it's a loan treatment. I have given an asset, I have taken 10,000 and I'll give you back 12,000 and take the asset. So it's a financial liability. So loan should be recorded. You have a lot of MCQ regarding this topic. So debit, bank, credit, financial liability. And what will the company do? The company will record interest expense over the year. Interest expense. Where will this interest expense be recorded? In financing category. Under which category? Financing category. The next one. If I say the repurchase price is lower, if the repurchase price is less than the original selling price, that means I have sold this for 10,000, but I will repurchase at 8,000. That means this will be treated as per IFRS 16 lease. So what will the company do? The company will record in the bank account that 10,000, they will record 8,000 as deposit liability they have to pay back in future, and the remaining 2,000 will be recorded as a lease income here over the period. But a question comes in the mind, sir. The question that comes in the mind is what? If the person will not come back, if the person will not come back and exercise the option, in that case, what? Today I have sold the goods to you, but I will not come back and repurchase. In that case, what will you do? You will record it as a revenue immediately after 2 years. If repurchase option is not exercised on repurchase date, then the balance in financial liability or deposit liability account will be transferred to sale. Whatever is the balance will be directly taken to sales. So with this, the repurchase agreement is also done. Last topic of IFRS 15, contract cost. Now this contract cost is in detail, but for your FR exam, the ACCA has mentioned some important note. For FR exam, for the purpose of FR exam, any cost incurred to fulfill a contract with a customer should be expensed to statement of profit and loss as they have incurred. That means what? It is a simplification which is done for FR exam. Normally, the cost which you incur, we record it as an asset, and over the year we take into P&L. But for FR exam, any cost which you incur will be recorded in what? P&L straightforward. Straightforward. Cost incurred in the current year but relating to future performance obligation would be recognized as a contract asset. I mentioned it is recorded as an asset, but are not examined in FR. Are not examined. Directly you record to P&L whatever cost you incur. I hope to everyone this is clear. Any doubts to anyone in IFRS 15? Okay. Now coming to the next topic, IFRS 9. We will do IFRS 9 financial instrument and then take a break. So IFRS 9 financial instrument. So what is a financial instrument, sir? There are three standards which we'll cover here. IAS 32, IFRS 7, IFRS 9. IAS 32 is what? IAS 32 will deal with the classification, whether it's a financial asset, financial liability, or equity. The second one is IFRS 9. IFRS 9, we will say what? Deal with how financial instruments are measured, at what value they are recorded, etc. XYZ. IFRS 7 deals with the disclosure part. So now coming to the definitions. What is financial instrument? Financial instrument is a contract which gives to both the, there will be two entities. Contract means one party, other part. For one entity it will be what? For one entity it will be financial asset. For other entity it will be what? Financial liability or equity instrument. Like if I say I have sold goods to you, for me it's a receivable, for you it's a payable. Payable is a liability, for me it's a receivable. So financial asset for one entity, financial liability for other entity. Financial instrument. Instruments include what? Primary instruments like receivable, payable, equity, security. Derivative instruments are also there. Your futures, options, this is not tested in your FR. It's not tested in FR. It's tested in SBR. Note, statutory obligation, statutory right, like I have to pay tax to the government, I have to get refund in the form of tax. All this will be This will not be a financial instrument. Understand? The statutory right to receive cash or to pay cash will not be a financial asset or a financial liability. It's not a financial instrument. Then coming to the next one, financial asset. Financial asset is what? Cash. Contractual right to receive cash, like your receivable or another financial asset from another entity. Today, I have a receivable from you. I say it's an asset for me, but you say, sir, we will not give you cash. You will say that, sir, I also have a receivable from my customer. That receivable you will give me. It becomes what? Another financial asset. Equity instrument of another entity. If you invest in any company shares, like you invest 5%, 10%, it's a financial instrument. If you invest more than 20%, significant influence. If you invest more than 50, consolidation. Then certain contract which will or may be settled in the entity's own equity share. Today I give a loan to you. It's a financial asset for me. Why? Because when you repay the amount to me, you are repaying this in the form of equity shares of my company, R Limited. So this is a financial asset. Financial liability is what, sir? A simple financial liability is what? Contractual obligation to deliver cash. Either you have the obligation to deliver cash, you have to give cash, or any other financial asset. And certain contract that will be settled in variable number of equity shares. It will be settled in variable number of equity shares. If it's in fixed number of shares, it is a equity instrument. It's a equity instrument. I hope you have understood this. So what is a financial asset, what is financial liability, and what is equity instrument? So in the class we have taken a lot of examples which are very important for MCQ to say whether it's a financial asset, financial instrument or not. So the important one are, I will discuss those. So the important is what here? Inventory, PP. These will not be financial asset. Inventory, PP, intangible assets will not be what? Your financial asset. The next one. The next one is what? The next one is prepaid expenses, advance given for goods or service, advance received. All this will not be financial instrument. Understand? Because there is no contractual right to receive cash. There is contractual obligation to deliver goods or service. There is no contractual obligation to deliver cash. Contractual obligation to deliver goods or service. Gold, it will not be a financial asset, but gold bond will be a financial asset, financial instrument. Any income tax payable or refund will not be financial instrument because it's a statutory obligation. This is as per the laws and regulations which is prepared. So with this is now coming to the important topic, classification. Under financial asset, what are the three categories? Amortization cost method, fair value through OCA, fair value through P&L. In financial liability, you have amortization cost method, fair value through P&L. This fair value through P&L will be followed for derivative. Derivative means in your exam, you should remember what? Short term. This will not be tested short term. Equity value will remain same. Equity value will never change. This can come in your MCQ. See, there is a difference. This is equity instrument. Under financial asset, can I say we have further categories? Debt instrument and equity. Debt instrument and equity. So see here now. Under debt, what are the model? Fair value through OCI, P&L, and amortization cost. In equity, we have two methods: OCI and fair value through P&L. Now this is what? Equity investment. This is equity instrument. So both are different. Understand that? So now with this is clear. Now what will I do? Let us first do the accounting treatment for financial liability. Once we do the accounting for financial liability, the other part will be easy. Financial liability recognition. When will the company recognize a financial liability? The company will normally recognize a financial liability when the entity becomes a party to the contract. Which contract? Financial instrument. Now, in the FR exam, all financial liabilities will be subsequently measured at amortized cost. So there are two methods in financial liability. Either we follow amortization cost method or fair value through P&L. Now, initial measurement. Initially, can I say initial? The financial liability will be recorded at fair value. At what? Fair value. So what does fair value means? What, sir? Fair value means whatever is the face value less discount. Less discount. Understand? So see now, what is the ultimate value? Net proceeds. If I am issuing today shares, if I'm issuing bond, in that case, if I'm issuing bonds, it is a liability for me. Now, what is the net amount I've received in my pocket will be the initial value. That means issue proceed minus transaction cost. Because you pay me what? I have given today bond value of 10,000 at a discount of 1,000. You pay me 9,000, but from this 9,000 I have to pay the broker also. So ultimate amount, how much did I receive in the pocket? You will reduce the transaction cost also. But if I say the financial liabilities at fair value through P&L, in that case, the transaction cost will go to P&L. Under which category? Financing category. Under financing category. Whatever relates to your financial liability, everything will be recorded in financing category. Subsequent measurement. Subsequent measurement in amortization cost method, what we do, sir? We use EIR rate, effective interest rate. We record in expense on EIR rate. Then the interest will be paid at what? Coupon rate. Interest payment will be based on coupon rate. Interest expense will be based on EIR rate. In fair value through P&L, what we do? The difference is taken by today my fair value is 9,000. At the reporting date, it is 12,000. 3,000 will go to P&L. Short-term liability, this is used. Finance cost will be recorded at coupon rate directly to P&L. That means finance cost will be recorded on what base? Finance cost will be recorded based on the coupon rate. That is 10,000 is my value into coupon rate in 600. Here there is no concept of EIR, effective interest rate will not come. So see now the amortization table. Opening balance, finance cost, financing category will take this payment whichever you make, and closing balance. So the effective interest rate will include what all? It will include the coupon rate, discount, transaction cost, and redemption premium. If you remember in the previous class, yesterday's class, we had done IAS 23, borrowing cost. In that I mentioned cost and other cost. Other costs are these four items. So discount is also a form of interest only. So it should be recorded over the period. Transaction cost is spread over the terms of the loan because the loan is giving the benefit for the 4 years, 5 years because of matching principle. Actual payment is paid on the face value by using the coupon rate. So let me take an example for this. Company issues bond with the following items. Face value 20,000. Coupon rate 4%. Term is 5 years. EIR rate is 7%. Transaction cost is 534. Discount is 500. Redemption premium is 10%. That means at the redemption date, I have to pay you 11,000. So CM, what is the face value? 20,000. What is the discount? 500. What is the fair value? 19,500. What is the issue cost? 534. Your cost will be how much? 18,966. So this is the net proceed which you receive as a company. You're issuing, if you're a company, you will be issuing, so it's a financial liability. So see the journal entry, debit, bank, credit, financial liability, then the finance issue cost. It should not be recognized in administrative cost. In most of your single entity question, this is the mistake the examiner will do. So please do correct it. So now what is the actual interest we paid? Face value into the coupon rate, whatever is the face value into the coupon rate, that is 20,000 into 4%, 8. But at the end of 5th year, how much will I have to repay? 20,000 plus 10% of that 22,000 I have to repay. So see here now, this is the table. So you record 18,966. Every year you do the table, you prepare this table and record. So this will be recorded as what? This will be recorded as a finance cost and you'll increase the value of financial. This will go to financing category. This what will you do? The value of the financial liability will reduce and cash will go out. So this is the combined journal entry which I passed in. So this is the way you do the calculation. So I hope the amortization cost method is clear to everyone in this case. Now coming to financial asset. Now financial asset will be easy for you. So see now, under financial asset, first we are discussing regarding debt instrument. What is a debt instrument? Debt instrument means we have to see from the point of view of the holder here. Example means if I have issued the bond, financial liability for me, financial asset for you. It is a financial asset for you and it is a debt instrument. What should you do? Two, for financial instrument, we have three categories: amortization cost method, fair value through OC, and fair value through PNE. Now, which model to follow? The default method is what? The default is fair value through PNL. This is used for short term. Fair value through PNL will always be for short term. Understand that. Will be for short term. Amortization cost model and fair value through OCA. To decide which model you should follow, you have two important tests: business model test and contractual cash flow test. Now, so business model test means what? Business model test means the company will hold this bond till maturity. As an investor, you will say that, sir, we will keep this bond until maturity. Business model. Contractual cash flow test means what? You will say that we will only get the contractual cash flow, that is the principal amount and interest amount. In case of AMC, excuse me, entity must hold the investment till maturity. If you are saying that, sir, we will hold this till maturity, amortization cost method, and intention is to collect what? Principal payment and interest. In the class, if you remember, we had taken the example of Raju and his girlfriend. Now Raju will say that I am committed to my girlfriend, even though if I get a chance to date any Bollywood actress, I will not. In that case, we say amortization cost model. For fair value through OCI, Raju will say what? If I have a crush on one of the Bollywood actress, I will take up this. In that case, same here. Intention to hold till maturity is that till the bond. But if someone is paying you very good amount for that financial asset, you will sell it. If you get a better opportunity, you will sell it. In that case, we say fair value through OCI. Your intention is there that I will hold till maturity. But if a better opportunity is available in the market, you will consider it for selling. And the intention is what? To collect the contractual cash flow. For fair value through PN, I mentioned what? The contractual cash flow test is not satisfied because the intention here is what? To purchase and sell. To purchase, sell, trade. So now see, initial and subsequent measurement for which one? For your debt instrument. Amortization cost method, fair value through OCI, fair value through P&L. Initial recognition. Initially, at what value we will record? We'll record at fair value, fair value, fair value. So transaction cost, what we do? We capitalize. Capitalize means you will add here. In financial liability, we reduce. Here we add it. For fair value through OCI also we add it. For P&L, we take to, in fair value through P&L, directly to P&L. Under which category? Investing category. Not financing. Financing for liability. Then recognition of income. Income will be based on EIR. Income will be based on EIR. Here income will be based on coupon rate. Coupon rate into face value. Subsequently, how will you measure? Amortized cost, fair value through OCI. Where will you take? You will see the difference. You will see the closing amount and you will see the carrying amount and the fair value. Whatever the difference, you will take to OCI, like your revaluation gain. For fair value through P&L, any difference will be taken to P&L. Sir, income where we will record? To P&L, P&L, P&L. Which category? Investing, investing, investing. Sir, on disposal, what will happen? On disposal, gain or loss will be transferred to P&L. Which category? Which category? Most of the time it will go to investing category. But if your debt instrument is regarding some relating to your business, like if I have a receivable, if I'm selling my receivable, in that case it will go to operating category. We will discuss this when we discuss the derecognition part. Then on sale, what will you do? Any gain will be transferred to OCI, which shall be transferred to P&L. So can I say your reclassification is allowed? So normally we record in OCI. From OCI, it will go to OCE. Then from OCE, again you can transfer to P&L. From P&L, it will go to retained earnings. This is known as what? Reclassification. In debt instrument, we can reclassify. And here it will go to P&L under investing category. Here the investing category. So now this is the debt instrument. Let us do a question which involves all these three things. See now. On 1st January 2000 X1, A bought 10,000 6% bond at discount of 1,000. A incurred transaction cost of 144. Interest is received annually in arrears. Bond will be redeemed at premium of 500 over its nominal value. The effective rate is 11%. Now what is the first? If A plans to hold the bond until maturity, A is saying that we will hold this till maturity. In that case, what will happen? Face value you will take, discount you will reduce it, you get what? We will get here 9,000. Then what? Transaction cost we will add it here. Actual interest is how much? 10,000 to 600. On redemption, what is the value will be getting back? 10,500. Now see here. Debit, financial asset, credit, cash of 9,000. Then finance cost we have amortized. We have added it here. So you prepare the amortization table. 914. Then interest income. It's not an interest expense, interest income. Then actual interest received we record. Then what we have the fifth? Closing balance. This closing balance will be present in non-current asset. And every year you will keep on doing this. So the entry you will pass this is as debit, credit, financial asset increasing, P&L as an income. Under which category? Investing category. This what will you do? Debit, credit. We reduce the value of the financial asset and we take this into cash is going. Cash is coming in here. It's an asset. So this is the first model. See now, in P&L, we record this, and in financial asset, at the year end, we will not record anything because you're receiving the amount back. Now in the case 2, case 2, that means what? Fair value through OCI. So please concentrate on this, avoid silly mistakes in this question. See now, A plans to sell the bond if possibility of any investment. It's possibility, it's not probable here. If any investment, if any better opportunity is available, we'll consider it. Amortization table. See now, opening balance, finance income, actual interest received, closing balance. Opening balance will be same as your amortization method. Your interest will also be on same as your amortization method. Oh no, see here. No, this is the opening balance. This is the amortization income. Actual payment is somewhat 600. You get your closing balance of 9,550. Now you should compare this closing balance with the fair value. The fair value will be given in the question. So you compare with 11,000. What is the difference? 1,450. This 1,450 should be taken to OCI. Will be taken to OCI. Understand that. Now next year what will happen? So next year my opening balance will be 11,000. But will you charge interest on this 11,000? No. The interest will be same as your amortization cost. That is 1,050. These second and fourth, third and fourth column will be same as the above one. Then you will record your closing balance 11,000 plus 1,050 minus 600. You get this. This again you compare with the fair value. You have a loss. You will it will reduce the value. It is a loss in OCI. The next year, what is the balance? 10,400 again. Then it's a finance income for you. Then what will you record? You record actual interest received 600 and you get the closing balance. Your closing balance and the fair value is 10,500. So this 400 will be a loss. So ultimately the value in the OCI will become 0 because first you recorded a gain of 1,450, then you recorded a loss of 1,450. So see here now. So in P&L what we record? Income as well as we record OCI 1,450, 150 minus 1,050 minus and 400. And in your balance sheet what you record? Financial asset for 11,000. You will record at fair value 10,400 and at the third year it will be 0. As well as you will record in equity what? Under equity you will record OC 1,450. Here you will record 400 and here it will become 0 because it is 1,450. Next year you have a loss. That loss will reduce the value. Ultimately the balance will be 400 in the books. So this is the fair value through OCI. Now coming for fair value through P&L. What will happen in fair value through P&L? See now, initial recognition at fair value. Fair value is what? Will reduce the discount. 9,000. Financial asset, debit, credit, cash. Transaction cost will go to P&L. So debit transaction cost, that is as an expense in P&L. Credit, cash or bank of 144. Interest income will be based on coupon rate and face value. Face value is 10,000 into 6. The income of 600 will go to P&L under investing category. Then on 31st December, the fair value is what, sir? 11,000. So we'll compare 9,000 and 11,000. Then what will you do? You will take this 2,000 into P&L. So debit financial asset, credit fair value gain 2,000 we recorded. So with this we have completed a question in which we have discussed all the three methods. Now coming to the next one, equity instrument. Coming to equity instrument, purchase of shares in other entity. It should be less than 20%. It should be less than 20%. So there are two methods, fair value through P&L, fair value through OCI. Which is the default method? Fair value through P&L. And fair value through P&L will be always be for short term. Fair value through OCI for long term. Understand that. Now, important point. Sir, initially we recorded fair value, no issues. So transaction cost in fair value through P&L, it will be taken to P&L. Under which category? Investing category. Then here what we do, here we capitalize it. We add to the value of the equity share. Then dividend income, what we do? We take to P&L, under which category? Investing category. Subsequent measurement at fair value, any difference will go to P&L. And gain or loss on disposal also will go to investing category. But the difference is what? The difference is in fair value through OCI. Any difference regarding the fair value, where will you record this? We will record this in OCI. Where we will record? In OCI. Then, sir, when we dispose of, sir, what we will do? The gain or loss also will be recorded in OCI. Now, from OCI, will you be able to reclassify? No. You record in OCI, from OCI it go to OCE, from OCE it will go to retained earnings directly. You will not bring to P&L. That means reclassification is not allowed here. Not allowed here. So now once the company will choose this fair value through OCI, can they come back and use fair value through P&L? Can they come back and use fair value through P&L? No. The company can never use this. If you have any doubts, once at the end of the session, you can ask me. If you have any doubts at the end, you can ask me. Now let us continue. So fair value through OCI is irrevocable option at the time of initial recognition. Once you record it, done. You can't come back and use fair value through P&L. So let us do one question so that this also becomes clear to us. So see now. Here this is the question. A purchased shares of Reliance for 1,800 on 1st Jan 2024. On 31st December 2024, the fair value of Reliance share price is 1,950. Transaction cost is 50. I say the company will follow default method, that is fair value through P&L. So the company will record investment in Reliance shares at 1,800 and they will record in the bank 1,800. Now transaction cost will go to P&L. P&L which category? Investing category. Under investing category. Then can I say the value of the Reliance share is increasing from 1,800, it is going to 1,950. So what is the difference here, sir? So difference is 150. So this 150 will be recorded back. So this 150 will be recorded in P&L. Debit increase in the value, credit P&L. Now the second method, if the company is saying that we will use fair value through OCI, then what? Same investment in Reliance 1,800, but here the transaction cost will be capitalized. Capitalized in the sense means what? Debit investment in Reliance shares, you will increase the value of Reliance share, and credit what? Transaction. No, yes. Transaction cost you record and credit bank. This transaction cost will be capitalized. You will increase the value of the Reliance share price. So now what is the value of Reliance share price? Investment in Reliance. It's 1,850. How much is the fair value? 1,950. So this increase of 100 will be recorded in OCI, not in P&L. So debit investment in Reliance shares, credit OCI. Then what we do? Debit investment in Reliance. It is how much? 1950. We have got the value. Now if I say the company is planning to sell, the company is saying that we will sell this for 2,000. So when the company is selling this for 2,000, what should you do? Cash is coming in for 2,000, financial asset is going out for 1,950. Now this difference of 50 you should record in OCI, not in P&L. Either you can record this journal entry or the other way. First increase the value of the Reliance shares. So from 1,950 it is going to 2,000. 50 is the increase in the value, yes sir. Then you consider selling it. Now the total gain in OCI is how much? This 100, this 50. So the total gain is 150. So will not be reclassified to P&L. This 150 will directly be taken to retained earnings. Will directly be taken to retained earnings. Understood this? So with this, the accounting treatment for financial liability, financial asset, debt instrument, three methods also we have done. Equity also, both the methods we have done. Now coming to the next important topic, compound financial instrument. So compound financial instrument means what? A very important topic for FR. Compound financial instrument means it has the characteristics of both equity and liability. So what should the company do? The company should follow split accounting. Before that, let us understand some basic terms. See now. If I say interest and dividend, it is compulsory to pay dividend. It is financial liability. It has the character of financial liability. If it is at the discretion, no need. The company, whenever the company wants, they pay. It is the characteristics of equity. If the borrowing is redeemable, that means we have to pay back, financial liability. If it's irredeemable, equity. If borrowing is convertible, whatever you have taken is convertible, and the conversion is based on variable number of shares, financial liability. If it is based on fixed number of shares and it is compulsory, it is a equity. It's not a compound instrument. If it is a convertible at the option of, that means the Company has the option. I, as a company, have the option to convert or not. In that case, either the company will decide whether to give cash or whether to give cash. In that case, the company will always give shares only. So it will be a equity. But if I say the person has the right, that means if today I have issued the bond, you have the right either to take cash or either to take what? Equity share. Then it is a compound financial instrument. In your exam, it will be directly mentioned convertible bond. So in that case, it's a compound financial instrument. Simple. Now, cumulative preference dividend leads to financial liability. Non-cumulative preference dividend leads to equity. For MCQ purpose, this which I've written, it's for MCQ purpose. This flow chart. Now, sir, what are the steps we should follow for compound accounting, compound financial instrument? The first thing is what you have to identify financial liability and equity. Sir, how do we calculate financial liability? Financial liability will be calculated as present value of the future contractual cash flow using what market rate? Using the market interest rate for similar instrument without conversion option. Without conversion option. This will be given in the question. Then you calculate equity component. Equity component is what? Total proceed minus financial liability. Step number 4 is what? Unwinding the financial liability. Unwinding the financial liability. So note, financial liability is measured at amortization cost method. Equity is measured at cost. Yes, sir. Now, if you have a transaction cost, if there is a transaction cost, then what will you do? In case of transaction cost, what do you do? If I say today, the value is 3 lakhs. Out of this 3 lakhs, 2,70,000 is financial liability, 30,000 is equity. And what will I say now? Understand it. What will I say here? My transaction cost is 10,000. This 10,000 should be allocated on this amount. Should be allocated on what basis? On what basis? 10,000 into 2,70,000 and divided by 3 lakh. You will get the transaction. Then 10,000 into 30,000 divided by 2,70,000. If by chance the examiner gives you, you should be able to do. I have not seen this being tested, but by chance, if they ask, you should be able. Then what will you do if you calculate the transaction cost? Allocate transaction cost to financial liability equity component in the ratio of the amount calculated above and deduct the amount and deduct from 2,70,000 and deduct from 30,000. And discount rate for interest calculation is what? Same rate which you have used for discounting. So what is the entry we pass? Debit, bank, credit, financial liability, credit, equity component. Now let me take an example. See here an example. A company issues 4% convertible bonds at a nominal value of 50,000. Interest payable annual in arrears. So in the first line only they mentioned convertible bond. So compound financial. Each 1,000 bond. So can I say that 50,000 is the value divided by 1,000 will be converted into 400 equity shares. So we have to see how many bonds we have. Then alternatively, the bonds can be redeemed at par also after 3 years. So cash also can be taken, shares also can be taken. The market rate applicable to non-convertible bond is 6%. The present value of $1 payable at the end of each year is based on what? 4 and 6%. The present value is given. Now you say me, which rate will you use for discounting? We will use 6%, not 4%. The examiner will give this for confusion purpose. So you use the market rate without conversion option. See here, what amount will be shown as financial liability equity when the convertible bonds are issued? Then see here now, the cash flow will be based on what? The cash flow will be based on the contractual cash flow. That means the face value. What is my face value? The face value 50,000 into 4%. So 22,000, 2,000, 2,000. And at the end of the third year, we have to consider the principal amount also. So you'll discount at 6%. Contractual cash flow you will take based on coupon rate, the rate which is given. But for discounting, you will take the market rate without conversion option. You will do this, you get the value. This value which is that will be shown as what's up. This value is your financial liability. What is the equity? 50,000 minus 47,350 is your equity part. So what is the entry? Debit bank 50,000, credit financial liability for 47,340, equity we record for 2,660. Amortization table we prepare for financial liability. When you prepare normal, you get 50,000 here. You get what? 50,000 here. So this is the entry which we pass in combine. Already we have learned this financial liability in detail. Now see in P&L, what will I show? Finance cost every year I'll show. In your balance sheet, what will I show? I'll show equity option. I will show non-current liability. And at the end of third year, I'll show current liability, because within 1 year I have to pay. At the end of the third year, it becomes a current liability. Now coming at the end of third year, what can happen? Either the employees will take cash. If the employees are taking cash, what will the company do? The company will reduce the 50,000 as a liability and give the cash. And then what will the company do? Can I say the whatever was the value in equity, we will transfer to retained earnings. Will transfer to retained earnings. Now see, convert to equity shares. If the shares are taken, in that case, what will happen, sir? Now we have to calculate the number of shares. If you remember that $1,000 value of shares with $1,000 value of the bond will be converted to 400 shares. So first we have to calculate the number of bonds. So when we calculate, we got 50 into 400. So 2,000 shares will be given by the company. And you know that equity, the share capital will always be recorded at what value? Will always be recorded at the face value. So the company will do what? The company will reduce the financial liability, the company will reduce the equity value, and they will credit what? Share capital, and the balancing figure will be share premium. Here I mentioned the face value is $1. In your exam, most of the time $1 or 0.5 only it will be given. So with this, the accounting of compound instrument is clear to everyone, I hope, with a basic example. Why I am doing each and every question? So that you avoid silly mistakes in your exam. Now coming to the derecognition of financial instruments. Sir, when should we derecognize financial instrument? First, financial asset. Financial asset will be derecognized when? Financial asset will be derecognized when there is no contractual right to receive cash flow. I do not have the contractual right to receive cash flow. Or when I sell my financial asset to someone, financial asset has been sold and substantially all the risk and rewards of the ownership have been transferred. So what is the accounting treatment, sir? The carrying amount minus the proceed which I receive will be, if I say my carrying amount is 10,000, I am selling this for 12,000. So this 2,000 is what, sir? This 2,000 is a gain. This gain where will we record? This gain I mentioned 99% it will be recorded in investing category. If the financial asset is relating to your business, like your trade receivable is also your this one only, what we say, financial asset. In that case, the gain or loss will record to operating category. If it is relating to bonds, some investment equity shares, etc., straightforward to investing category. Now the important topic which comes in your exam is factoring. Now let me take an example so that you understand the factoring part. This is the part. See now the example. R Limited is there. R Limited has a receivable of $10,000. R Limited is in need of money. Today, R Limited sold goods. They have receivable, but they need money today. But the receivable, the customer will pay after 3 months. But R Limited needs money today. So what will R Limited do? R Limited will sell this receivable to B Limited. So B Limited will say what? Okay, you are selling this receivable. What we do? This receivable is from whom? Ram. Ram has to pay me. But Ram is saying that I have purchased goods on credit, so payment I will do after 3 months. But R Limited is saying that we will need the fund today only. So R Limited will sell this receivable to someone. That someone is known as factor here. That is B Limited. So now this B Limited will say that we will pay you 9,500. So can I say 500 is an income for whom? For factor. But now what happens? B Limited will only receive 4,000 from R Limited. Then B Limited can do what? Either B Limited can come back to R Limited and ask the money, or B Limited will sit simply and be quiet. Now B Limited will have the first option. B Limited will come back and ask that R Limited give my money back because Ram did not pay. You mentioned that Ram will pay, but Ram did not pay me now. You pay me. That means the risk and rewards are not transferred here. The risk and rewards are not transferred. That means B Limited is coming back to you and taking the amount. If I say that B Limited will not come back to you and ask the amount, in that case we say risk and rewards are transferred. So see here now. Without recourse, with recourse. With recourse means what? B Limited, the factor will come back to you. If the factor is coming back to you, It's not a sale. It's not a sale. So what should we consider? It's not a sale. Risk and rewards are not transferred. So will you de-recognize the asset? No. Financial asset will be recognized. Financial asset will be recognized. So what we will do? The company will record the amount which they have received as a loan. Record the amount received as a financial liability loan and treat this as per IFRS 9 normal. So see here, A has receivable of 20,000 and has received 19,000 from the factor in which the risk and rewards are not transferred. In that case, debit cash, credit financial liability 19,000, 19,000. If I say it's without recourse, without recourse means the person cannot come back. In that case, factor cannot come back. It's a genuine sale. That means risk and rewards are transferred. Factoring fees will be higher. De-recognize the financial asset. Difference will be taken to what? Difference in the carrying amount and the proceed will be taken to P under investing category. If it's a receivable, it's your operating category. If it's your receivable, it will be where? Operating category. Understand? Then, sir, receivable was 20,000, we received 18,000. So, in that case, can I say we received 18,000 and here we will de-recognize the trade receivable. Why we will de-recognize? Because the risk and rewards are transferred. So, the difference will be a loss as a factoring charge or as a loss in your P&L. So, with this we have completed. Now, coming to the de-recognition for what? Now, coming to the de-recognition for liability. De-recognition for your liability. So see here now. For financial liability, when will you de-recognize financial liability? If I say I have a receivable, you have a payable. Once you pay me, you will remove the payable from your books because you do not have contractual obligation to pay now. So financial liability will be de-recognized when the obligation is expired or the obligation is not there. So accounting treatments are difference. Carrying amount and you will compare the amount which you have paid. That difference will be either a gain or either it will be a loss. If I say you had a liability of 10,000, you paid 10,500. That means 500 you're paying extra. This is a loss for you. Vice versa. If you're paying less, it will be a gain for you. Now coming to the next small topic for theory, offsetting. Sir, if A is there, B is there. A has a receivable from B and A also has a payable to B. That means you are my customer, I am your customer. Same. Receivable is also the payable. So can I say my receivable is 10,000, my payable is 8,000? Can I directly say that my receivable is 2,000? Can I record it as a net figure? Yes, you can record this as a net figure when the other party is same. From you whom you are purchasing on from whom you are purchasing and for whom you are selling are one only. So offsetting can be done. The company can directly show 2,000 as a receivable when it is legally enforceable. They should have a contract done. It should be legally possible and a contract should be done between both the entities and intents either to settle on net basis. That means I will say A what? I'll say to B. A will say to B that okay, you need not pay me because you have because you have to pay me how much? 10,000. I have to pay you 8,000. I will not pay you what? 8,000. You directly give me 2,000 only. I will be happy with this. That means intents either to settle on a net basis or to realize the asset and liability on asset and settle the liability simultaneously. A will say what? You give me 10,000 now. On the spot, I will give you back 8,000. Either A will say what? You give me only 2,000. Or A will say what? Give me 10,000 first and I will give back to you 8,000. This is, if these are the conditions, we can do offsetting. The next one, the last topic, treasury shares. Treasury shares means what? Buyback of shares. Now, if a company is there, the company will buy back the shares. If the company will buy back the shares, then what will the company do? Whatever is the buyback, the company will reduce from the equity box. Whatever is your equity calculation in your balance sheet, the company will record this as treasury shares and they'll reduce the amount here. Why will the company repurchase the shares? The company will repurchase the shares. Either the company will reissue in the market. Either the company will reissue or the company will do what? Or the company will cancel. If the company is cancelling the shares, whatever difference will come, that difference will go to PA retained earnings. It will not be taken to P&L. But if the company is just keeping with them for reissue, they will reduce the value from share capital and share premium and show it. So with this is also done. This comes for MCQ. So we have discussed your IFRS 9 financial instrument is also done. So with this, three standards are done. Now the other standards are pending. So let us do one thing. Let us take 10 minutes break, come back and do the remaining standards. So the time is now 8:25. Everyone be back by 8:35. Please take a break, everyone. And we'll be doing small standards also after doing the two. Sir, question? Which question? It's the revision of IS and IFRS totally. Chalo, 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 chalo. Come back, come back, come back, come back. Today the session will extend little bit because we have to complete a lot of standards yet. Still, we have a lot of standards to be completed. Chalo, chalo, everyone are back. Yes or no in the chat box? Thumbs up. See, I can't waste a single minute, so I'll not do some time pass, etc. The sessions are focused on revision, so even a single minute I'll not waste. Understand that. In a regular class, we do time pass also, everything we learn also. But here, it's a revision, so we'll not waste even a single minute. Chalo now. Your time is also important, my time is also important. Very precious time is very important. So now we covered the three important topics: IFRS 16, IFRS 15, and financial instrument. Very important topic from your exam perspective. Then IFRS 7 disclosures. What are the disclosures that should be given? See, you should mention what are the assets which are classified as fair value through P&L, what are the financial liabilities at fair value through P&L, what are the assets which are capitalized at amortization cost, fair value through OC. You should just give a brief discussion. Then, on what basis did you decide whether it should be recorded in fair value through OC or fair value through P&L, etc. So, disclosure of gain or loss also should be disclosed. What is the gain or loss on fair value through P&L, fair value through OCI? How much is the amount we have reclassified, if we have sold any asset, if we dispose of any asset, any gain or loss, that also should be disclosed. Not so important, but just for your idea, I have mentioned what that is disclosed. Now coming to the next important topic, IAS 33. This IAS 33, I've uploaded a revision video on my YouTube channel for IFRS 15 also, IAS 16, then your financial instrument, EPS also. It 20 to 25 minutes along with questions. Same thing we will do here also now. We'll try. IAS 36, EPS very important for your section B, section A. Section C, if it's a very good day, I say that you can get for 4 or 6 mark calculation question. If not, mostly in section B only. So what is EPS, sir? Earning per share. What is the earning per share? If I say today the company is earning 10,000 and the number of shares are 1,000, that means per share the earning is 100. Today, if I invest in the company, my earning in this company will be how much? 100. So now IAS 33 EPS, earning per share. Now see the objective. What is the objective for EPS? The objective for EPS is to help the investors to do the comparison, or to is important to compare the performance of the company with what. This will help to measure the company's performance, whether the company is doing good or not. And then what the company can do, the company can compare previous year EPS, this year EPS, so that the investor will get to know, okay, whether the company is growing or not. As well as what we can compare the EPS of the current year. We can compare the EPS of this company with the other entity, so that we get to know. I hope this is clear to everyone. So the first thing, we compare EPS with the current year and the previous year of the same entity, or we compare the EPS of this company with other company to get a better understanding which company is doing better. See, EPS is not a single ratio which the investor will see. The investor will see a lot of other things also, but EPS is an important indicator. Then scope, sir. EPS should be calculated for separate financial statement. EPS should also be calculated for consolidated financial statements. Now, what are the types of EPS? The types of EPS is what? Basic EPS and diluted EPS. So now what is diluted EPS? In the class, regular class, I mentioned what is diluted EPS. I mentioned that Raju is married to one, and Raju is planning for the second marriage. In that case, when he has married the first person, son is that. Now, whatever net worth that belongs to Raju will belong to whom? The son. But now this son will have a fear that if my dad will marry someone else, in that case, if they have a son, in that case, this property will be divided, or the net worth will be divided. So in this case, we calculate basic. But in future, my net worth will be divided. So in that case, it's an example for diluted EPS. So I hope everyone have understood what is basic and diluted EPS. Diluted EPS means the earning is divided. In future, sir, the earnings will be divided. Why? Because the number of shares will increase. So basic EPS, what is the formula? Profit loss attributable to ordinary shareholders. When you do this calculation, you take into account preference shares, whatever dividend you pay. Then what's a weighted average number of shares outstanding during the period? The most important part is this calculation. So yes, so profit attributable to ordinary shareholders, how do we calculate? Profit or loss attributable to ordinary shareholders as adjusted for post tax effect of preference dividend. So we consider the effect of preference dividend also. We reduce the preference dividend. Then, and non-controlling in this NCI, non-controlling interest, when in case of preparing the EPS for consolidated books. In that case, if it's individual financial statement, then no need to consider this. What you will take the profit figure, you will reduce the preference dividend. Then after that, whatever is the remaining will belong to equity shareholder. So net profit for the period less preference dividend for individual company. If NCA is there, you will reduce the NCA part also here. So this is that. So see now, note, OCI will not be the part of EPS. Understand, whatever you record, revaluation gain, etc., will never be the part of EPS. Preference shares. If preference shares is redeemable preference shares, in that case, what should we do? Sir, if it is redeemable preference shares, can I say it is a liability? If it's a liability, already the preference dividend which we pay is already taken into consideration. It is considered as a financial liability under IAS 32. So interest will be treated as finance cost. Interest will be treated as a finance cost, and it would have already been adjusted. So no need to do the adjustment again. If we say your preference shares, that is non-redeemable preference shares, can I say this is what? It's an equity. So what we do after, once we get your profit after tax, we reduce the preference dividend here. Now understand. If cumulative preference share, then deduct the dividend always. If it's cumulative preference shares, we deduct every time. If non-cumulative preference shares, then deduct the dividend only when declared. Cumulative means every year. This year dividend is not paid, so next year the company have to pay previous year also, this year also. It's cumulative. Non-cumulative means this year the company did not pay, no issue. Next year they only have to pay next year dividend. In that case, for cumulative, every year you will reduce. But for non-cumulative, when it is declared, then only we will reduce it. In your exam, mostly the question will be very simple, and they'll say you that the preference share is classified as a liability. So if it is classified as a liability, no need to do any adjustment, because already it will be done in the profit calculation. If it is a non-redeemable, please reduce the preference dividend. Now coming to weighted average number of shares. In weighted average number of shares, three issues we have. If the shares are issued at market price, if there is a bonus issue, or if there is a right issue. See here. Let us take the first example for market issue. Company A had 400,000 $1 equity shares in issue on 1st April 2005. On 1st October 2005, it issued 600,000 shares at a market price. Profit for the year ended is how much? 57,000. So normally what we take, profit attributable to equity shareholders divided by weighted average number of shares. So profit is how much? 57,000. Now, sir, the number of shares are how many? 4 lakh plus 60,000. So how much is this? 4 lakh 60,000. So we will take 4 lakh. Is this right? This is the wrong way to do calculation. This is the wrong way. So what is the right way? Because we have to time apportion. Because the 60,000 shareholders, will only get the profit after 1st October. Whatever is the profit after 1st October, that only will be attributable to these shareholders. So what should we do? We should time apportion. So we say, sir, 4 lakh shares are for 6 months, 6 divided by 12. After that, market issues are. So the number of shares will become what? 4 lakh 60,000. So 4 lakh 60,000 into 6 divided by 12. Or either you can do what? 4 lakh into 12 divided by 12, 60 into 6 divided by 12. Both the ways. But in the class, I mentioned that you should follow the timeline approach so that you will never make mistake. So this is the basic question. So the market issue is very easy. So no such issues in this. Whenever the shares are issued from the date, consider the time, do the weighted average, because you have to time apportion it. So with this, the market issue is clear to everyone. Now coming to bonus issue, sir. In case of bonus issue is also known as what? Scrip issue, capitalization issue. If in the examination, the examiner is using the term as scrip issue or capitalization issue, it means bonus issue only. Now, whenever the company is giving bonus, will there be any additional shares? No. No, the shares will be there additional, but will the company get any additional resources? No, they'll not get any amount. So see here, does not provide additional resources to the issuer means that the shareholder owns the same proportion of the business before and after right issue. That means the ownership will remain same. The ownership will remain same. A MCQ question: if bonus issue is that, will the ownership of the shareholder remain same? Yes, it will remain same. So in case of bonus issue, the shares are given, but the shareholder will not give even a single rupee. It's for free. We say free shares. Now see, for bonus issue, what is the accounting we have to do? A bonus issue has no consideration and therefore treated as if new shares have been in issue for the whole period. That means you'll apply retrospective treatment. Retrospective means what? Going back and doing the adjustment. The number of shares in issue before the bonus issue must be adjusted by bonus adjustment fraction to reflect the proportionate change. That means to do retrospective treatment, we are calculating bonus adjustment fraction. So bonus adjustment fraction is what's a 1 plus bonus ratio. So see, if bonus ratio is 1 is to 4, so my bonus fraction will be what? 1 plus 1 divided by 4. 4 ones are 4 plus 1 divided by 5 are 4. So it is 5 by 4. The comparative figures and any other figures from earlier period presented must be adjusted. This can be done by multiplying the comparative by the inverse of the bonus fraction. That means whenever the company will present the balance sheet and P&L, they will give 1 year data extra. They will give the previous year also. They will give the previous year data also, so that we can, so that the shareholders can compare it, so that the shareholders can do the comparison. In that case, what should you do? The previous year EPS we should restate. How should you restate? If I say EPS is 2, you should take this bonus fraction. It is 4 by 5. No, you should reverse it 5 by 4 and do, you will get the restated EPS. So see here now. Now understand, bonus issue is given from share premium. Bonus issue is given from share premium. That is the reason the company will not get any additional cash. So the number of shares are how many, sir? 20,000. Earning is how much? 20,000. So on 1st October 2000 X3, bonus issue is done. Bonus issue is done for 1 is to 5. So at 31st December 2000 X3, so year end is what? 1st January to 31st December, and the bonus issue is done for on 1st October. So this is for how many months? 9 months? 3 months. So now what is the first thing, sir? First thing is bonus issue. How much is? 1 is to 5. That means for 5 shares, you will be getting 1 shares. So we calculate the bonus adjustment factor. How much is that? 1 plus 1 divided by 5. You get 6 by 5. Your bonus adjustment fraction is 6 by 5. This 6 by 5, you will adjust it. This 6 by 5, you will adjust it. So now see here. Excuse me, 20,000 divided by the number of shares is how much, sir? 20,000 into what? 6 by 5. Or if you do the timeline approach, we will get the same. So can I say for 9 months, 20,000, 9 divided by 12 into 6 by 5. Then once I do the bonus issue, how many shares will be there? 4,000. So 24,000 into 3 by 12. If you do this, you will get 24,000 as the answer. So 24,000 will be your value. So 20,000 is my earning divided by the number of equity shares. So you get the EPS as 0.833. Now, if previous year EPS is 0.6661, we have to restate. How will you restate? You will take the EPS, you will reverse that. It was 6 by 5, you will take 5 by 6 and calculate the amount. So with this, the bonus issue is also done. I hope there is no doubt in this calculation. Next, coming to right issue. Right issue mean what? In this case, right issue means the company is issuing additional shares, and this right will be given to the existing shareholders, and the existing shareholders can purchase the shares at a lower price when compared to the market. See, right shares are those shares which are issued by the company to its existing shareholders at a price lower than the market value. Right issue present special problem. So right issue will contribute you money. Right issue will contribute additional resource also, as well as if I say 10 rupees is the market price, the company issued at 8. So can I say this 8 is the amount which you receive, the company will receive, and 2 is the amount the company will not receive. So right issue has what? Right issue has the characteristics of both market issue and bonus issue. Right issue has the characteristics of both market issue and bonus issue. So this 8 is what, sir? Market issue. This 2 is what? Bonus issue. So we have to adjust both. Therefore, they contribute additional resources. They are normally priced below the market price. Therefore, they combine the characteristics of issue at full market price. Effect is taken from the issue date, and bonus issue effect taken from the earliest date by right adjustment factor. By right adjustment fraction. So now how do we calculate this right adjustment fraction? Market price before issue. Before the right issue, what is the market price? Divided by theoretical X right price. Now, sir, what is theoretical X right price? Theoretical X right price is the price after the right issue. What is the market price after right issue? And it is based on theory calculation. It is not based on the practical world. You just do a theory calculation. You do calculation for knowledge purpose. In market, either the share price will go up, go down, depends upon the market sentiments. But here what is important, you calculate this is market price before issue. This is what theoretical extract price. Right price basically means the price after the right issue. So now see here, let me take an example directly so that you'll understand. So number of shares is how much, sir? 10,000. Earning is how much? 70,000. On 1st October 2004, 1 for 5 right issue is done. So issue price IC is $4. In the market, what is the price, sir? 6. So in market, the price is $6. We are giving for $4. That means, sir, this is a right issue. The value is low. So that 4 is what? The 4 is what? Market issue, and the 2 is your bonus thing. So now what is the first thing we have to do? The earning we know 70,000. Then we have to calculate the weighted average number of shares. To calculate weighted average number of shares, we need right adjustment factor or fraction. So for that, first we have to calculate theoretical X right price. Now theoretical X right price, there are two methods. So the easiest method is this one. So how many shares? For 5 shares, 1 share is given. So the 5 shares will be at the value of 6, and the 1 new share will be at the value of 4. So the total value will be 5 6 are 30, 4 1s are 4. So the total value of the shares will be 34, and this 34 relates to what's a 6. So what is the price here in the market once the right issue is done? 5.64. As per theory calculation, it should be 5.67. Now this 5.67 is what's a theoretical exercise price. This I have done for individual shareholders. You can do on a total basis also. You'll get the same answer. No issues there. Step 2 is what's a RAF. You have to calculate. So what is RAF? 6 divided by 5.67. 5.67. Because market price before issue was how much? 6 divided by theoretical exercise price. Then step number 3. Step number 3 is weighted average number of shares. So how do we calculate? We take 10,000. So see here now. Until 1st October, everything was fine. So what should we do? We will take 10,000. We'll multiply 9 divided by 12, and we will take into consideration what? We will take into consideration the right adjustment fraction. We will take this for 9 months. Now after 9 months, can I say right issue is done? So if right issue is done, how many shares are given? Can I say 2,000 shares? So that 2,000 shares I've taken into consideration. So we'll add that. So after right issue, how many shares will be there? 12,000. These 12,000 shares will be for 3 months. So you do this, you get the weighted average number of shares as 10,937. Then what do? Step number 4, you calculate the EPS. 70,000 divided by 10,937, it is 6.4. Step 5, what we do? Step 5, we restate the previous year EPS. So how? You will take the previous year EPS. Excuse me, I say the previous year EPS is 7. You will multiply this with right adjustment factor, right adjustment fraction. So how much is the right adjustment fraction? 6 divided by 5.67. So I will reverse this. Same 5.67 divided by 6. Whatever we have done in whatever we have done in bonus issue, like restating the EPS, same thing we have to do here also. We have restated the value. You'll do this, you'll get the value. So with this, we have discussed bonus issue, right issue, and market issue with basic examples. Now in your exam, a question could come saying that there are multiple issues. Then you have to do properly. You should avoid mistake in that. So with this, The EPS basic is clear to everyone. So bonus issue is done, sir. Market issue, right issue is done. Now basic EPS we have completed. Basic EPS we have completed. So let me take one example regarding this one. Multiple issues together. So see here now. This is the example. We have 10,000 shares. Market issue is done for 2,000. Bonus issue is the right issue is done. In that case, for market issue, no such problem. Bonus issue, can I say we have to calculate bonus adjustment factor? For right issue, we have to calculate right adjustment factor. Now they have given the market price. They have given the this also the right price 8. So now you say for right issue, can I say we have to calculate theoretical X right price? Yes, sir. So now how many shares are there? For every 3 shares, we are giving 2 extra shares. So 3 shares will be at 10 and 2 shares will be at 18. So your theoretical X right price will be 46 divided by 5. So here see now we have calculated this. Your right adjustment factor also you have to your right adjustment factor will be what? 10 divided by 9.2. Now, sir, bonus fraction is how much? Bonus is 1 plus 1 divided by 5. So 6 by 5 is your bonus adjustment fraction. Now, how do we calculate the weighted average number of shares? To calculate the weighted average number of shares, what should we do? What should we do? See here now. 10,000 we have taken? Yes, sir. Now, after how many months there is an issue? Sir, after 3 months. So 10,000 into 3 divided by 12 into what? Bonus adjustment factor, right adjustment factor. Done. Now, after this, can I say market issue? So, market issue shares I'll add. 2,000 is the market issue I've taken into consideration. After how many months there is an issue? Sir, after 4 months there is an issue. So, 4 divided by 12. Now, for these 4 months, can I say I will consider bonus adjustment factor and right adjustment factor. So, 6 by 5, 10 divided by 9.2. Now, the date is first 8. On this date, bonus issue is done. So, now bonus issue will be done for 12,000 shares. Understand? So what will I do? I will take 12,000 divided by 5. So how much will this be? It is 2,400. So 2,400 plus 12,000 shares. The number of shares will be how much? 14,400 into right adjustment factor, because we have not yet come to the adjustment for right issue. So we'll consider this into 2 divided by 12. After 2 months again you have a problem here. So 2 divided by 12. So then what you do? Then you consider the right issue. So can I say right issue will be done for how many shares? 14,400. It is what? 3 divided by 2. So 14,400 divided by 3 into 2, that is 9,600 plus 14,400. It's 24,000 shares. 24,000 shares into how many months? 3 divided by 12. This is the way you do calculation for weighted average number of shares. Sir, if we have to restate the EPS, in this case, what we do? We take both. We take 5 by 6 into 9.2 divided by 10. Both right adjustment factor, bonus adjustment factor, both we will consider. So with this, it was a very good revision, I hope. Now, chalo to the next topic. The next topic is what, sir? Diluted EPS. Diluted EPS means basic thing. Diluted EPS means in future the number of shares will increase. If the number of shares are increasing in future, that means the earning will be divided. If the earning is divided, today only we will show. Today only we will calculate the diluted EPS so that the shareholders will know. If this year you calculate EPS, this year EPS, but after 3 years, I say these shares will be issued. In that case, your EPS will take a dip. The EPS will fall down drastically. In that case, the shareholders will have a shock. In order to avoid the shock, what we will do? Today only we will calculate the diluted EPS, keeping in the mind that in future these shares will be issued. Diluted EPS is calculated when there are outstanding potential equity shares. Potential equity shares are those securities which can be converted into ordinary shares in future. Example, convertible instrument, share option warrants. Now, diluted EPS means reduction of basic EPS. If same earning will continue with additional number of shares, when potential equity shares will be converted into ordinary shares. So, conversion into ordinary shares may increase the numerator and denominator. So, we have to see numerator and denominator why it will increase. Denominator for sure it will increase because of the number of shares. Sir, numerator also will increase. Yes, numerator will increase because if it's a convertible bond in future, you will give the shares. Once you are giving the shares, the interest which you pay, you will save that notional earning. So change in numerator and denominator may increase or decrease the existing basic EPS. So if there is a decrease in EPS, this is known as diluted EPS. So we should present this in what? We should present in the we should present this in SOPL. If I say other way, if there is an increase in EPS, when you calculate this, if the values increased, the values more when compared to the normal EPS, it is known as anti-diluted. You need not show this. You need not show this. Anti-diluted EPS is not required to be reported. In that case, your basic EPS and diluted EPS will be the same. So see what is the formula for calculation. The formula for calculation is what? Earnings plus notional extra earning divided by number of shares plus notional extra shares. So see here, let me take an example. Company A had issued 8% 10,000 convertible 10,000 convertible loan, each of 100 value is converted into 40 shares. Okay, in future each $100 of bond will be converted into 40 shares. The tax rate is 30%. Earning of the company for the year is what? 80,000 and had 20,000 share in issue. So the basic EPS will be what, sir? Earning is 80,000 divided by 20,000 is the basic EPS. For diluted EPS, can I say 80,000 20 plus additional shares? The number of shares will be how much now? Can I say 10,000 divided by 100 into 40? This will be what? 4,000 shares additional. So these are the additional shares. Now what is the notional earning? So can I say on this how much is the interest we are paying? 10,000 into 8%, that is 800. But this 800 will not be your full saving. 800 will not be a full saving. The net saving will be what? Only 70%, because that is a tax rate of 30%. In the class, regular class, we have detailedly discussed why this is there, etc. XYZ. Because it was an expense. Expense will reduce your tax. Now you're not claiming an expense, so your profit will, your notional earning will reduce. So how much is this? So the formula is what? We write down this face value into coupon rate. Then 1 minus 30 percentage, that is the tax rate. So ultimately my saving will be 70% only. So that will be 560. This 560 I will take it here. Then you get the diluted EPS. This is for what? This is for convertible. This is for convertible. Now here it is given 8%. If in the question they mention EIR rate, take the EIR rate, huh? Because the interest expense is based on EIR rate. Now see, if there are multiple conversion options, multiple possible scenarios for the number of equity share conversion, then consider with the maximum number of equity shares. So if they say that $100 can be converted to 30 shares, $100 can be converted to 35, $100 can be converted to 40. In that case, which one we will take? We will take this highest one, that is 40. If convertible instruments are not issued at the beginning of the period, then the effect should be taken from the date of issue, both numerator and denominator. That means if I say the convertible instrument was issued between the year, in that case, what should we do? We should do 6 by 12. We should do 6 by 12. We should time apportion it both. With this part is clear to everyone. I hope there is no such doubts. All the 9 points which are written becomes a MCQ question in your section B. 10,000. 10,000 is the value of the bond. $10,000 it is. Now, okay, it's $10,000. Chalo, this is the convertible part. Now coming to share options and warrants. That means the company has given the employee share option. They can purchase. In this case, what will happen? See, options and warrant to subscribe for shares. An option or warrant gives the holder the right to buy shares at some times in future at a predetermined price. Today the company is giving you an option to purchase shares after 3 years, but the price will be determined today only. If today the price is what, 10, and in future it can become 50, 20, etc. XYZ. So let us see what it is. Cash is received by an entity at the time the option is exercised, and the DPS calculation must allow for this. The total number of shares issued on the exercise of the option or warrant is split into two. The number of shares that would have been issued if the cash received have been used to buy shares at the fair value in the market. The remainder, which will be treated as a bonus issue. Let us do a question, you will understand. The number of shares issued for non-consideration is added to number of shares when calculating diluted EPS. Means what will happen? The price is 20 in the market, but you can purchase this at 8. That means this 12 rupees is a benefit. So this benefit will be treated as a bonus shares. You have to calculate this in the number of shares and add it to the denominator. So see here now. A formula for diluted EPS with an option can be used to work out the number of free shares. So the free shares will be what? Number of options into fair value minus exercise price divided by fair value. So see here. Company A has an earning of $100,000. Number of shares at the start of the year is how much? 20,000. Company A had issued share option of how much? 10,000 shares. Exercise price is 3. Average market price is how much? 5. Average market price is 5. Calculate the diluted EPS. So my basic EPS will be what first? $100,000 divided by the number of shares is how much? 20,000. So we recorded $5. Now you only say 10,000 shares. If you go to the market, how much you pay? 50,000. But if you pay now, if you have this option, how much you're paying? 30,000. So what is this now? 20,000 is the benefit. This 20,000 you will divide by 5. You are getting 4,000 extra shares. You are getting 4,000 extra shares. If not, just remember this formula, you will get the calculation. Number of options are how many, sir? 10,000. Into fair value is how much, sir? What is the fair value in the market? The average price, that is 5. What is the exercise price? 3 divided by 5. You will get 4,000. Or you can use this method. Both the methods. This is the easiest method. Remember the formula so that you get. So now this 4,000 shares will be added to the denominator. Numerator, nothing will come. No difference. It will remain same only. $100,000. So additional share. 20,000 plus 4,000, 24,000. Your EPS is how much? Diluted EPS is 4.16. That means it was 5 and it becomes 4.16. With this, I hope the diluted EPS is also clear to everyone in case of share option. In share option, the numerator will not be affected. Only the additional shares we will be adding to the denominator. Then coming to the theory, which is frequently tested in your exam for section B. Now see, EPS is used to calculate what? P ratio. What is P ratio? Market value of the share divided by EPS. If I say P ratio is 100, that means what? For $1 of earning or for 1 rupee of earning, we are paying 100 rupees. If the P ratio is very high, that means the share is expensive. Problems arising from EPS as a performance measure. Can I say EPS will be affected by accounting policy and it can be manipulated? EPS is based on profits and profits can be manipulated. Either the company can use cost model, revaluation model, LIFO, FIFO, a lot of things they can manipulate. EPS is a historic figure. It will not predict about the future. It is based on the historic data. This is a disadvantage. Then EPS is a measure of profitability, which is only one aspect of performance. Nowadays, shareholders will not only see profitability, they will see a lot of other things also. Many companies now place much higher significance on other performance measures such as customer satisfaction, cash flow, manufacturing effectiveness, innovation, etc. Now, the presentation, how will you present? EPS will be presented for profit and loss from continuing operation, profit or loss for the period, and it will be shown in what? It will be shown in your P&L. It will be shown in P&L. Your diluted and basic EPS should be given equal importance. Understand that. So this is the annual report of one of the companies. See how they present the EPS. This is the way the EPS is written so that the shareholders can compare it. What are the disclosures we give? The general disclosure, what's the numerator which you have taken into consideration for calculation? What is the denominator we have taken into consideration for diluted EPS? How did you calculate the weighted average number of shares during the year, whether that was right issue, bonus issue, etc. If in case of diluted EPS, when you do, you come and the answer becomes, and the answer is what? Anti-diluted. That means the EPS is more. It is anti-diluted. In that case, you have to mention this and you have to record it. What is the value, etc. XYZ. Then a description should be given about the shares which are issued, whether it was equity shares or any some potential voting rights are given to them or not. You have to mention this in disclosure. With this, your EPS is also completed. Any doubts in EPS, anyone?
No, sir.
No doubts? Okay, chalo then. The next important topic, IAS 12, income tax. In our regular classes, we have spent more than 8 to 9 hours to do this concept. A lot of questions we have done. But now we will be exam focused. I'll say you what are the important points you have to remember. But before that, income tax. This income tax is what a separate line item in your P&L. If you know, you have operating category, investing category, financing, then you have income tax, and then you have discontinued operation. So these are the 5 category as per IFRS 18. Now a question will come in mind, sir. Why should we learn income tax, sir? It is straightforward, no, sir. Excuse me. It is what you calculate the accounting profits, sir, into 30 percentage. 3,000, no better. Your accounting book is totally different. Your tax book is totally different. There are two things: accounting book, tax book. You pay the tax based on taxable books. You pay the tax based on tax rules and regulation. Each country will have its own rules and regulation. The tax is paid on the taxable profit. How do we calculate taxable profit? We prepare a tax book. Like accounting books, we also prepare tax book. So now income tax will consider two things: current tax and deferred tax. Now what is the current tax? Understand. Let me take first an example which we have taken in our class so that everything will be clear. Now see this example. Cost of an asset is how much, sir? 10,000. Depreciation is how much? 20 per. This depreciation is a as per which books? Accounting books. Depreciation as per tax books is how much? 25 percentage. That means there is a difference here. That is the reason deferred tax will come into picture. Your deferred tax will come into picture because of a reason.
I don't want to talk to an Indian bloke.
Temporary difference.
What?
It's a Zoom meeting.
Your deferred tax will come into picture because of a reason that the tax rules are different and the accounting rules are different. But ultimately, at a certain point, the value will be same. So see here now, cost of the asset is 10,000. It is 20 percentage depreciation as per tax accounting books, 25 percentage as per the tax book. So the profit is how much? 20,000. So now, as per our accounting books, how much is the expense? 10,000 into 20%, that is 2,000. As per income tax books, it is how much? 10,000 into 25, so it is 2,500. So in the income tax book, in the tax books, the depreciation is more. If the depreciation is more, that means you pay less tax. See here now, year 1, year 2, year 3, year 4, this is as per accounting books, this is as per tax books. So profit is 20,000, 20,000, 20,000, 20,000, 20,000. Depreciation 2,000, 2,000, 2,000, 2,000, 2,000. So how much is the how much will be your profit after this one? It is 18,000. Now this 18,000, on this 18,000 you will apply the tax. How much is that, sir? 30 percentage. So 5,400, 5,400, 5,400, 5,400, 5,400. Ultimately you pay tax of 27,000. But when you do, but do you pay the tax as per the accounting books? Never. You pay the tax as per income tax books. So now see here, 20,000 minus 2,005, 17,500, 17,000, 17,000, 17,000, and then 20,000 you pay. So here you will say, sir, accounting book says the tax is how much? 5,400. But as per the tax authority is saying that you should pay tax of 5,250. So you will be happy saying that my tax expense was 5,400, but I'm only paying 5,250. So you will be very happy that I'm paying less tax. No, no, no. The tax authority will say for a temporary period, you are paying what? 5,250, 5,250, 5,250, 5,000. The amount which you paid less here, at the end of fifth year you will be paying the difference. The 600 which you have a saving for the first 4 years, you will pay at the end year. So that means what, sir? That means this out of this 5,400, 5,250 is my current tax, 1,150 is my deferred tax. Today you are enjoying, but in future you will have a problem. Today you are happy, but in future you will be sad, you have to pay the difference of 150. So today only you know that I have to pay, so you record it as a liability, deferred tax liability. So that is the reason the tax will come to 5,400 in the books. So ultimately 27,000 here also 27,000, but only timing difference is that today you pay less, in future you pay more. In case it is DTL, if today you pay more, in future you pay less, DTA, deferred tax asset. So I hope with this the concept is clear to everyone. We can't go in detail now. Chalo, income tax, current tax, and deferred. Current tax means what's a tax which is payable as per the tax book, taxable profit. Can I say in the example it was how much? 5,250. But your deferred tax is how much? Your deferred tax is 150. Understand? This deferred tax is because of what reason, sir? Because of temporary difference between the carrying amount and the tax base of the asset and liability. So accounting profit means as per IAS and IFRS. Taxable profit means as per the tax rules, as per the laws and regulations of each country. Temporary difference, that means there is a difference between the carrying amount of the asset. See, ultimately in this example, the value of the asset will become zero. If you see in the accounting books, my carrying amount is 8,000. Here it is 7,500. Ultimately, at the end of the fifth year, it will become zero only. But there is a time difference. That is the reason we have deferred tax. So with this, now chalo, let me discuss the current tax. In current tax is what's a taxable profit into tax rate. So what is the journal entry pass? This year tax we pay next year. This year tax we pay next year. Understand? So, but we have to record the expense this year. So we estimate. It's a provision for us. Debit deferred tax expense, credit provision for current tax. So it's an estimate. So this year you say, this year you have estimated that I have to pay 10,000 tax. But in the next year, when you submit this to your tax authority, they say that you have done some calculation mistake. You have to pay 12,000. So in that case, there is a difference. So any difference between the estimated and the actual amount will be recognized in P&L as an expense in the period of payment. When the payment is done, in that period only you will record it as an expense, because it's a prospective treatment. It's an estimate. So prospective treatment will be done, not retrospective treatment. Understand that? So under or over provision from prior period. So now see you know example. In the current year, you recorded a tax of 50-50. In the second year, what do? You pay this out of, you pay 60. That means it was a under provision. Previous year you record less expense, but this year you're paying more. So you remove the provision, you remove the, and what is the difference will be recorded in the second year as an expense. In the second year, you'll again the estimate the second year tax. This is income tax and provision for tax liability 77. In the P&L, what will you record? So 70 we will record plus this under provision. So under provision you will add it. Over provision you will reduce it. In your single entity question, it will be mentioned on the debit and credit side. Debit side, it is an under provision. Credit side, it's an over provision. So in SOFP, we show 70 as a liability in the books. Over provision, what will happen, sir? Income tax expenses 50-50. But in the next year, you're only paying 45. That means I recorded more expense previous year, but I'm paying only 45. So I'll remove my liability 50. So on the credit side, I record it as an income. So this is what, this is your over provision. So over provision, you'll reduce. And the second year also, you'll estimate the tax 70-70. So what in SOPL, 70 minus 565 is the expense. In balance sheet, it will be 70. So this is the treatment for under over provision, which is very important for single entity. Every time a question will be that. So if it's on the debit side, it will be what? Under. Credit side, over provision. So to everyone, this is clear, I hope. Deferred tax. Now there are two types of differences. The first one is permanent difference, temporary difference. If there is a temporary difference, tax consequence will be there, and you create a DTL or DTA. Permanent difference will have no tax consequences, so it will not give rise to any DTA or DTL. The examples are government grants, donation, penalties, and fines. The government will not give any concession for these items. So now, sir, how do we calculate the deferred tax asset or liability? Now you have to learn taxable temporary difference. Whenever there is a taxable temporary difference, it is what? Deferred tax liability. If it's a deductible temporary difference, it is what? Deferred tax asset. Now, sir, how we will get to know whether it's a taxable temporary difference? You have to remember this. You have to compare the carrying amount of the asset. You have to compare the tax base. Now, question mark comes, sir, what is tax base? Tax base means carrying amount as per tax book. In your exam, it will be mentioned. No such issues in this. We have done. So now, if my carrying amount of the asset is more, my tax base is less. Can we change the tax base? Never. It's not in your control. Sir, can we change the carrying amount of the asset? Yes. Can you reduce the value of the asset? Never. You can never reduce the value of the asset, but you can increase it. Sir, we can't reduce. So what we create a DTL, we create a liability so that the value of the asset will come down. Sir, in case of liability, asset carrying amount is more, tax basis is DTL. For liability, it is opposite. Value of the liability is less, tax base is more. So we'll increase the value of the liability. It is a deductible temporary difference, so DTL will be created. Sir, taxable temporary difference, DTL. For deductible temporary difference, sir, this means what? Saving of tax in future. That means today you are paying more, in future you will pay less. Simple. So deferred tax asset. Deferred tax asset will happen when the carrying amount of the asset is less and the tax base is more. So we'll increase the value. So we create an asset. Like your class 11th and 12th bank reconciliation, same thing. Liability, in case of liability, my value of the liability is more, my tax base is less. Can we reduce the value of liability? Never. So we create an asset so that the value of the liability will come down. This is what deferred tax asset. Now, sir, deferred tax asset, if it's a liability, it will be recorded as an expense. It will increase your income tax. If it's a deferred tax asset, it will reduce the value here. And we will do this on a cumulative basis. A lot of transactions will be done. We'll compare the opening, we'll compare the closing balance, and during the year, what is the difference for your P&L. Now see, tax of transaction must be accounted for in the same manner in which the transaction is accounted for. That means if the difference is there between the carrying amount of the asset and the tax base, and that is because of inventory loss we record in P&L, so the deferred tax also will be recorded in P&L. If I say I have an asset today, the value is 12,000, but the fair value is how much? 12,000. The company is using revaluation model. If the company is using revaluation model, can I say the carrying amount in the books will be at 12,000, but the tax authority says that we never believe in the concept of revaluation, so it will be 10,000. So the difference is of 2,000. This 2,000 will be recorded by this 2,000 is a difference. It is a taxable temporary difference. It will create a liability for you. So this 600 I will record in what? We'll record in OCI, because the revaluation gain is going to OCI. The taxation relating to the tax relating to revaluation also will go to OCI only. Understand? So recognition not important, tax base also not important, but directly it will be given in your question. Tax rate. Now what is the tax rate you have to use? Tax rate is the rate which has been enacted or substantially enacted at the reporting period. So for the current year, the tax rate of the current year only you will use. It will be issued by the government. Sir, for deferred tax asset, what should we do, sir? For deferred tax asset, the next year or future year tax rate you have to use, if you know. If you do not know, then use the current year tax rate only. For MCQ, it is important. And in the your FR exam, the AC examiner will directly give you the value. Now see this one. The steps to solve any question. Step number 1 is what, sir? Calculate the carrying amount of the asset as per IAS and IFRS. Calculate the tax base, that is as per income tax rule. Then calculate temporary difference, whether it's a taxable temporary difference or deductible temporary difference. Determine the tax rate. 99.99% it will be given in your question. Then am I audible? Yes, okay. Give me 1 minute. There is a problem with the screen, but I hope everyone can see the screen here.
Yes, sir.
Yes, okay, chalo then. Now see here what we will do. Calculate DTA or DTL. We'll take deferred tax deductible temporary difference into tax rate. We get a DTA. For deductible temporary difference, we get a DTL. This will be a closing balance.
For each and every asset you will do, understand, you will compare for intangible asset, you will compare for tangible asset, you will compare for liability, you will get a DTA, you will get a DTL, you will get a lot of things. You will do the net value and calculate the closing balance. You will do the net value and calculate the closing balance. You will calculate the closing balance. There should be no issue in this part. Then what should you do? Compare the balance of deferred tax calculated under step 5 with opening balance. The opening balance will be given in the question because this closing balance which you have calculated is from the day when you purchase the asset. But in P&L, we record the expense for the current year. So you take the opening balance, you compare with the closing balance. If the liability is increasing, it's a deferred tax expense. If the liability is decreasing, it's a deferred tax income. Then in the balance sheet, deferred tax is recorded under non-current asset. If it's a deferred tax asset, if it's a deferred tax liability under non-current liability, we will record this. So deferred tax asset and liability should not be discounted. Here we will not follow the concept of discounting here, because if we follow that, if we follow, can I say what will happen? If we follow this, the
Give me 1 minute, everyone. Audible?
Yes, sir.
Yes, okay. Chalo, yeah, no issue. So see now this deferred tax discounting we will not follow. Now coming to 2 or 3 areas which are frequently tested in FR. Deferred tax on revaluation. So whenever there is a deferred tax on revaluation, what we do, deferred tax should be recognized on revaluation gain or loss. Any deferred tax on original carrying amount of asset before revaluation shall be charged to P&L. Any deferred tax on revaluation, if it is a gain, DTL will come. If it's a loss, DTA will come. So if it's a revaluation gain, sir, where we will record OCA. If it's a revaluation loss, your deferred tax will record in P&L. So DTL on revaluation surplus is shown in OCA with revaluation gain. So if today I say the carrying amount of the asset is 10,000 as per accounting books, as per accounting books, and the fair value is how much? 12,000. But as per tax book, the carrying amount is 9,000. So can I say you will compare 12,000 and you will compare 9,000? So the difference is how much? 3,000. Can I say this 3,000 is a taxable temporary difference? It will create a DTL. Now I say the tax rate is 30%. So how much is this? 900. So we'll take debit, credit. It is a DTL of 900. Debit what? You have to see what will go into P&L and what will go to OCI. So now for OCI only you will give the revaluation part. So how much is the revalued amount? 2,000. So 2,000 into 30, 600 will be recorded to OCI and the remaining 300 will be recorded to P&L because of revaluation gain only the difference is of 2,000. On that 2,000 only taxable temporary difference will be created that will go to OCI. So in revaluation surplus, how will you show this in OCI? You will say that 2,000 is my gain minus 600 is the deferred tax. So the ultimate value will be 1,400 in the OCI and the revaluation surplus. We have done this. Then see now, unused tax losses. This means what? Understand. If today we have a profit of 10,000, you pay tax on this, you pay 3,000. Now, if you have a loss of 10,000, will the government give you back amount? The government will not pay you. The government will never pay you. So what should we do in this case? In this case, the government will say that, okay, when you are making profit, we are taking tax. But when it is a loss, we will not tax you. What you can do, this loss is done, you can carry forward this in the future years you can carry forward. If I say next year I have a profit of 6,000 and then next year 6,000, this 10,000 I can carry forward. So that means the next 2 years, even though I'm having profits, I will not pay tax. My tax will become 0 here. Here it will be 4,000 only. So on 2,000 only we pay profit. So can we record this as a DTA today, deferred tax asset? Yes. See now, unused tax losses. The entity should recognize a deferred tax asset against unused tax loss if it is probable that future taxable income will be available. Whenever you want to record a deferred tax asset, in future you should have taxable profit. MCQ question. In future you should have a taxable income. Then only you will be able to record what? You will be able to record deferred tax asset, and carry forward is allowed. The tax rules or the tax rules and regulations of the country should allow this to be carried forward. If the company is saying that you can only carry forward for 1 year, that means you will create a deferred tax asset for only 6,000. You will not create for 10,000, because only in the next year you only have, you are estimating that in the coming next year, in for the next year we'll have a profit of 6,000. For the 6,000 only you will create deferred tax asset. The asset is equal to the tax losses expected to be utilized multiplied by the tax rate we have considered. If entity does not expect to have taxable profit in future, it cannot recognize the asset in its own account. They cannot recognize deferred tax asset. The third, gain or loss on financial asset. If you remember, in your IFRS 9 we follow what? Fair value principle. Tax authority never believes in the concept of fair value. So tax authority says that the fair value which you're recording, we will believe this once you sell the asset. So whenever you record in the in your accounting books the financial asset at fair value, in the tax books it will be at the cost only. So this creates a difference. If there is a gain, if it's fair value gain, then it creates what? It creates a taxable temporary difference and a deferred tax liability is created. Sir, if it's a loss, sir, on financial asset, then it is a deductible temporary difference. It creates a deferred tax asset. So deferred tax asset is recognized in the same section of profit and loss and other comprehensive income as the gain or loss on the financial asset. If it's at fair value through P&L, you record the deferred tax in P&L. If it's at fair value through OCA, you record the deferred tax asset, deferred tax expense also or income in the OCA only. So with this, we have completed the discussion of IAS 12. Now see a summary, which is important. This is the, in P&L, what should you do? First, you will write down the current year liability. Current year, how much is the expense? That will be given in a single entity question. Add under provision from the trial balance on the debit side, on the credit side. Take this value. Over provision, you reduce. Deferred tax charge, you will add it. Expense, that means a DTL. If it's a deferred tax asset or your deferred tax liability is reducing, it is a credit. So this will reduce the expense. So this is the total amount which you show in P&L. So now how should we calculate this deferred tax? See, you prepare a ledger account, your T account, you write down the opening balance here, you write down the closing balance. Excuse me, during the year you will have something that will go to P&L as well as in OCA, and you will you will see this side, either it will, either there will be charge or either there will be a credit. You have to compare. If I say your opening balance is 10,000, your closing balance is 12,000, in that case what? 12,000 is the greater number, here also 12,000. So that means 2,000 is a charge during the year. 2,000 is a charge, so I will add this 2,000 here. If I say ulta reverse, if I say ulta reverse, here the opening balance is 12,000. It's a liability. My value of the liability is now only 10,000. That means what? Sir, 12,000. This also should be 12,000, sir. That means here we have 2,000 as a credit. That means your value of the liability is coming down. If the value of the liability is coming down, we record this as a negative figure. A very important summary for your single entity question. So with this, we have completed what? We have completed your this one. All the 5 important standards are done. Any doubts to anyone? Jessica mentioned it's clear. Okay. So IS 2 we have done. IS 40 we have, 41 we have done. Now IS 21. It will not take much time. All are small standards. So IS 21. IS 21 is what, sir? IS 21 is the effect of changes in exchange rate. So whenever there is an exchange rate change, what is your risk? Can I say the risk is whether I have to pay more or I will receive less? So see here now, the objective of this is what? We will cover foreign exchange transaction, this standard, translation of financial statement of foreign operations, translation of financial statements of entity into presentation currency. These two are not tested in FR. These are the part of SBR. In for FR, what is important? Foreign exchange transaction. It is important. So now, to understand this chapter, first we have to understand the basic principles, the types of currency. First, we have to understand what is functional currency, foreign currency, and presentation currency. So the first currency is what's a presentation currency. Presentation currency means the currency in which the financial statements are prepared. The currency in which the financial statements are prepared. So foreign currency means what? Foreign currency means the currency other than functional currency. Foreign currency means the currency other than functional currency. Functional currency means what then? So functional currency is the currency of the primary economic environment in which the entity operates. That means your books will be prepared on what basis? Functional currency. The day-to-day journal entries will be passed in which currency? Functional currency. So what is functional currency? The primary economic environment in which the company operates. There are indicators to determine. So primary indicators and secondary indicators. The company will use this to determine it. So primary indicators are what, sir? The currency which influence your selling price, the currency which influence your cost, like your labor cost, material, etc. The currency of the country whose competitive force and regulations are taken into consideration when you determine the price. If I am in India, can I say my sale price will be affected, or it will be quoted to everyone in rupees? If I'm in India, I'm doing my business in India, can I say my cost also will be in rupees? Yes. Now when I set my price for the goods and service, can I say I consider the competitors in India, I consider the rules and regulations of India? So in that case my functional currency will be rupees. If the company is not able to identify with primary indicators, then they will shift to secondary indicator. In secondary indicators, what are the things? Currency in which the funds for financing activities are generated. From where, in which currency I have taken a loan? Did I take a loan in dollars? Did I take a loan in pounds, rupees, etc.? The currency in which the receipts from operating activities are retained. Once I do the business, I have the profit. That profit, in which currency I am retaining it? These all are the indicators which you have to use to identify whether it's a functional currency or foreign currency. So if I say it's dollars, rupees, rupees, then which one will be a functional currency? Rupees will be a functional currency. Day-to-day journal entries will be passed in which currency? Rupees. So this is the basic of the standard. Now see here, the functional currency is not obvious. Management must use its judgment in identifying the currency that most faithfully represents the economic effects of the underlying transaction. Once a functional currency is identified, it should only be changed if there is a change to the economic climate in which it was initially identified. Sir, can we change the functional currency? Yes. A lot of time this has been tested for MCQ. A lot of time this has been tested for MCQ. Understand? So when will you say, sir, can we change the functional currency? Yes, we can change the functional currency when the underlying economic environment has been changed. In that case, we can change. True or false question can come regarding this. We can change your functional currency. Now see, monetary items and non-monetary items. For what is monetary items? Understand. Unit of currency held, an asset and liability to be received or paid in fixed or determinable number of units. So monetary item means monetary items are those items where the amount which you receive is fixed, or today only you know what is the amount you will be receiving, like your loan, cash, receivable, payable are what? Monetary items. Non-monetary items are what? Which are not monetary, other than monetary items. So where the amount which you receive is not fixed, you don't know what is the number of unit of currency you receive. In this case, we say non-monetary item. So what is the example? PP, goodwill, inventory. Why are we doing this classification? This classification is very important to learn the accounting treatment here. So see here now, accounting for foreign currency transaction. Now today I say that I have sold goods to a customer. My currency is what? Rupees. My foreign currency will be what? Dollars. I sold 10,000. I have sold goods to a customer for 10,000 rupees. Now the customer is in US. Now the customer is saying that I will not pay in rupees, I will pay in dollars. In that case, can I say I am bearing the risk? If the customer is saying that I will pay in rupees, then no issues for me. If the customer will pay in dollars and my currency is rupees, then it creates a problem for me. So foreign currency transaction is a transaction that is denominated or requires settlement in a foreign currency. Requires settlement in a foreign currency. Either you do the settlement or you denominate in foreign currency. It creates a problem because you are bearing the risk. The customer is not bearing the risk. Note some important terms. Historic rate or spot rate. Historic rate or spot rate means the date or the rate on the date the transaction take place. Today, if I have done a transaction, what is the rate today? Now, I have sold the goods to the US customer. What is the exchange rate in the market? $1 is equal to 90 rupees or 89, etc. XYZ. It is what? Spot rate. Closing rate is what, sir? At reporting date. At reporting date. Spot rate means what? The date, the rate on the date of transaction. Closing rate means at the balance sheet date. Average rate means what? The what is the average rate throughout the year, throughout the accounting period. Now see, initial recognition. A foreign currency transaction is initially recorded by converting it into functional currency at the exchange rate on the transaction date. That means initially when there is a foreign currency transaction, you will multiply and record that transaction on the same date at the spot rate. At the spot rate. So for practical purpose, we use the average rate, but in your exam, the values will be given straightforward. Do the accounting. Now you should understand the quotation here. If I say rupees to dollars, that means $1 is equal to 90 rupees. Always this right hand side will be 1. Always right hand side will be the 1. And you compare $1 is equal to, if I say it is dollar to rupees, that means 1 rupee is equal to 0 point some dollars. This way it will be presented. So avoid mistake in this. Students will do a lot of mistakes in this only. Now see, sir. So subsequent recognition, what should we do, sir? Today, when I have done a contract with a person, I have recorded based on the spot rate. Today, if I sold $10,000 of goods, I have converted this and I have recorded into rupees 80,000, 80,000. 80,000. Now this 80,000 will be what my receivable, and on the other side it will be a revenue. Now can I say my receivable is what? Your receivable is your monetary item. So for monetary item, what should we do? Monetary item, remeasure all monetary item at exchange rate on reporting date, your balance sheet date. If any exchange gain or loss is there, directly take to P&L. Directly take to P&L. In P&L, which category? In P&L, operating category. In non-monetary asset, sir, for non-monetary asset, is it compulsory to retranslate? Understand. For non-monetary item, if the asset is, if the company is following cost model, if the company is following cost model, then no need to remeasurement. No need to do remeasurement. When you purchase the asset, you record it and you depreciate it. Sir, if the company is using fair value method, then what should we do? We have to retranslate it. We have to retranslate it and determine the exchange gain or loss. Now, in non-monetary also, there are two things. The transfer exchange difference gain or loss to P&L if such non-monetary item is measured to P&L, such as inventory. Can I say the value of the inventory will be cost or NRV? It will change. Whatever is the exchange gain or loss will go to P&L. If I say a transfer exchange gain or loss to OCA, if such non-monetary item is measured through OCA, like your revaluation, when you do revaluation, can I say we get exchange gain or loss also? We get fair value gain or loss also. If you're recording the gain to OCA, record the exchange gain or loss there. If you're recording the loss to P&L, then record the exchange gain or loss to P&L. So you need not separate it. You should record in a single amount. So see now, foreign exchange transaction relating to trading operating category, related to investment in property financial asset investing category. If it is relating to some borrowing like you have taken a loan, it's in your financing category. Financing category. Let us take some examples here now. Company A sold goods to a overseas customer on 1st October worth $1,000. But the functional currency of company A is what, sir? Rupees. The payment is made by the customer on 31st March 2000 X9. So can I say today we have entered into a contract and it is a foreign currency transaction. The functional currency is rupees. So $1 is equal to 80 rupees. I've quoted the exchange rate. So on the day, what we do, we record receivable, we record sale. That is 1000 into 80, 1000 into 80. Why? $1 is equal to 80 rupees. I said that it is $1000. So how much it will be cross multiplication? You do, you get the answer as 80,000. Yes, sir, we have record. Now your receivable is a monetary item. Can I say if it is a monetary item, we have to retranslate. So how much is the value? Dollar exchange rate on the balance sheet date 31st 12 2008. $1 is equal to 85. So what will I do? Debit receivable, credit PNL. Now my how much is my receivable now? My receivable is 85,000. I recorded 80,000, but my receivable is how much? 85. My receivable is increasing. That means it's a gain for me. So debit receivable, credit PNL, exchange gain in operating category. Now, sir, when we come on the settlement date, when I receive the payment, on that date, what is the exchange rate? $1 is equal to 95. That means how much is the amount I'm receiving? I'm receiving 95,000 in my bank account. But my receivable is how much? My receivable is 85,000. Understand? 80,000 plus 5,000, 85,000. Then what is the difference? 10,000 is my exchange gain or loss. It's a gain for me. I will record this in operating category. A basic question. The next one regarding your payable. Company A purchased goods from an overseas supplier on 1st October 2008 worth $1,000. Functional currency of the company is rupees. So it's the case of payable. So we record on the first day at spot rate $1 is equal to 70 rupees. Debit purchases credit payable. So 1000 into 70, 1000 into 70. We record payable as 70,000, 70,000. Now it's your balance sheet date. Now how much? $1 is equal to 72 rupees. So how much should I pay? I should pay 72,000 now. I should pay 72,000. That means I recorded my payable as 70,000, but my payable is increasing. If my payable is increasing, that means what? It is a loss for me. Exchange loss. So 2,000, 2,000 you record. On the date of settlement, you are paying how much? 75. That means what? Sir, I have to pay 75,000. So bank credited by 75,000. My payable was of 72,000, and the remaining will be what? My loss into P&L. So with this, I hope the basic is clear to everyone. How do we record it? Now coming to some advanced questions here. Question 3. Company A sold goods to overseas customer worth $1,000 on what date? On 1st March 2008. Functional currency of the company A is what? Rupees. Customer paid how much? $600 on 30th June 2008, and the remaining will be received in next year. The reporting date of the company is what? 31st 12 2008. So can I say during the year only there is a payment? So on 1st March 2008, I entered into a contract. So $1 is equal to 70. So what will I do? On the day when I've done the transaction, I'll record it. Debit, receivable, credit, sale. 70,000, 70,000. That is $1,000 into 70. It's 70,000. Now can I say out of this $1,000, I am doing the payment within the year? If I'm doing the payment, will this balance be considered at the reporting date? No, it is not considered. So it should not be restated. You have to finish it now because we are doing the payment here. So for 600, can I say it is what? 42,000. For 400, it is 28,000. Now on 30th June 2008, we are doing the payment. So how much is the payment on the date? $1 is equal to 72. So 72 I am receiving. $1 is equal to 72. How much will I receive? 600 into 72. So I'll receive 43,200. But my receivable was how much? Regarding 600 was 42,000. That means my receivable was 42,000. I received 43,200. It's a gain for me. It will go to operating category. Now, can I say at the balance sheet date, my remaining receivable is how much? 400. This 400 I have to restate. So what is the exchange rate here? My exchange rate is $1 is equal to 69. So now what will happen? 400 into 69. It is 27,600. But how much is the value you have recorded? You have recorded 28,000 as a receivable. But how much is your receivable? 27,600. So there is a decrease in receivable. If there is a decrease in receivable, it's a loss for us. We record in operating category as a loss. Then the same question, you can try this for your payable also. Same type, you can try this question for payable. Then coming to loan, the favorite topic of the examiner for F7 as well as SBR. even though this is not mentioned in your publications, the normal books which you use, but it is mentioned, study of it is mentioned, so you have to do. Nothing new in this. Normally you prepare amortization table, you normally prepare the amortization table. So what should you do? You should prepare the amortization table in foreign currency first. So foreign currency, you will prepare it. What you do then you just multiply the exchange rate. You multiply with the exchange rate and calculate the difference. So you'll get here A, it's B, C, D, and E. So if you multiply with the exchange rate, you get your balance. So you get your closing balance. This closing balance which you get, A plus B minus C, will not be equal to this closing balance. The difference will be your gain or loss. The difference will be your gain or loss. So see here now an example. Loan taken on 1st January 2008 for $1,000. Effective rate is what? 12. Coupon rate is 10. Interest is paid on 31st 12 2008. Now this opening balance, you will convert this based on opening rate on 1st January. Interest which we have recorded will be based on average rate, because interest expense is for the throughout the period. For you will use the average rate. Sir, actual payment will be converted based on what? The exchange rate when the payment is done. If I say payment is done on 31st 12 2008, then 31st 12 2008 we will take the value. Then closing balance on the reporting date, whatever is the exchange rate, then whatever is the difference will be your exchange gain or loss. So see here now, I have taken $1,000. This into 12% $120. My payment is how much? $1,000. So how much is my closing? 1,000 plus 120 minus 100. It is 1,020. Now I will multiply with the exchange rate. Opening balance I'll multiply with the opening rate. My opening rate is how much? 90 here. I've considered 90 and 90,000. My interest expense, what is my average rate? The average rate is 87. So I multiply this with 87. I get this. Then I say my actual payment. Actual payment is done on what? 31st 12 2008. The actual payment on the date rate is 85. So I say the payment is done of 8,500. So now if I do this 90,000 plus 10,440 minus 88,500, I get 91,940. But when you multiply this 1,020 into 85, how much is the closing balance? 86,700. As in your account, in your books, what is the value? 91,940 as per rupees. But as per dollars, how much it should be? As per dollars, and then you convert into rupees, it should be 86,700. So this difference of 5,450 is a gain for you, because the value of the liability was 91,000, but it should be 86,000. The value of the liability is reducing. It's a profit for you. Again, you will record this in financing category, because this is relating to a loan. So this will be recorded as a finance cost. This will be recorded as a reduction in the value of the loan. Understood, everyone? But loan value should be 86,000. So financial liability is reducing. So exchange gain we have this one. So with this is the part we have completed. Now coming to non-monetary item. Non-monetary item, cost model. Cost model, if you purchase any asset and you're recording under cost model, should you retranslate at the reporting date? No need to retranslate. So today I purchased a PP of $1,000 on 1st Jan 2024. Functional currency of the company is rupees. Company A follows cost model as per IAS 16. Useful life of the PP is what? 5 years. Company A plans to sell the asset at the end of year 2 for $700. So on the day when I purchase, I will convert this into rupees. So debit PP credit bank, that is 90,000, 90,000. That is how 1,000 into 90. Then normally what will I do? I will charge depreciation for the year 1, 90,000 divided by 5 years. Second year also depreciation. So how much will be my carrying amount? Can I say my carrying amount at the end of second year is 54,000? Now the company is selling the asset. If the company is selling the asset, the company is selling the asset for $700. So $700 into the exchange rate on the date is $1 is equal to 92. So how much will I receive? 64,400. So can I say my carrying amount of the asset is how much? 5,400. Now can I say this credit is what, sir? 10,400. Can I say this 10,400 includes exchange gain or loss and gain or loss on the sale of the asset? It includes both. So no need to retranslate at each reporting date. In case of your non-monetary asset, which is under cost model, you need not retranslate. Simply you will, once you record, then normally what do you do? Normally you charge depreciation. Under revaluation model, see now, I purchased an asset for 10,000, exchange rate is 90 on that day, so I record asset 90,000, bank 90,000. Now useful life is 5 years, so I depreciate. If I depreciate for the first year, my carrying amount is how much? 90,000 minus 18,000, it how much? 72,000. But the company is using revaluation model. At the end of first year, the fair value of the asset is how much? 1,200. 1,200. So this 1,200 I will retranslate. How much is my carrying amount? 1,200 into 89 into 89. How much we get? 106,800. But how much is the carrying amount in your books? 72,000. But how much should be the value? 1,06,800. So the value is increasing by 34,800. Now this 34,800 is an increase because of two reasons. One is exchange gain or loss and fair value gain. Now, should we separate this? No need to separate better. Directly, you will record this where in OCI, because the revaluation gain is recorded in OCI. The exchange gain or loss also will be recorded in OCI. So, debit asset, credit OCI revaluation surplus 34,800, 34,800. So, with this, we have completed the questions plus the discussion of the standard. So, what are the disclosures? See now, the exchange gain or loss during the period. Then what is the presentation currency? What is the functional currency? What is the foreign currency? Everything you have to mention. How did the company decide whether this is the functional currency? What are the factors? You have to mention that in the disclosure. So with this standard is completed. So see here, I mentioned if monetary financial assets or liability fair value through P&L, your fair value change is also recorded in P&L, exchange gain or loss also in record in P&L. If it's a non-monetary asset under revaluation, you record revaluation gain in OCI, you record your gain or loss also in exchange gain or loss also in OCI. If inventory is measured, your investment property, IAS 40 is measured at fair value, gain or loss will go to P&L, exchange gain or loss also will go to P&L. The important one is what are monetary financial assets. Monetary financial assets or liability as fair value through OCI. In that case, what should you do? The fair value changes will be recorded in OCI, but the exchange gain or loss will be recorded in P&L. You have to separate this and record it. A very important point. For monetary financial assets or liabilities which are at fair value through OCI, liabilities though will not be carried at fair value through OCI. Can I say financial asset? In that case, the fair value change will be recorded in OCI. Exchange gain or loss will be recorded in P&L. Understood, everyone? With this, the standard is done. So for today, we are done. The remaining we will continue tomorrow. So tomorrow we will do consolidation revision and the remaining standards. In the class, in our regular class, we have done a question regarding this topic. So please do practice this for fair value through OCI and remember for your MCQ part. So with this, today we have done the revision of part 2, 5 important standards and IAS 21. So tomorrow we will complete consolidation and the remaining standards. The remaining standards are what? IFRS 13 fair value, a very small topic, IAS 8, IAS 10, IAS 37. So with this, can we end the session now? I hope the session was very good. Thank you. Okay, bete. Others? Yes, okay. Thank you. Okay, okay, okay. Welcome, welcome. So with this, we can end the session. So tomorrow, same timing, it will be 6 to 9:30. It depends. So we'll try to complete tomorrow consolidation and we will try to do the remaining standard, the remaining part. So bye bye. Have a good day. Signing off. Radhe Radhe to everyone.